Before we start this video, do like and subscribe to our channel and not miss on any updates.
Friends, let's learn about employee stock option plans. To understand this chapter, which is like very simple, very simple and super interesting, let's take some examples from real life and then you can really relate to what I'm talking. Imagine you are working in a company. This is the company you're working in and this company is doing extremely well. So this company makes, say, medicines and sells those medicines. So this company is doing extremely well. You work very hard in the company and at the end of every month, all that you're getting is a salary check saying, okay, take this 1 lakh rupees, take this 2 lakh rupees, that's all. You're only getting your salary check home, but company is earning crores and crores of profit. In a case like that, you as an employee may get a feeling at some point of time, I'm working so hard and all this hard work is not for myself, all this hard work is for company. I'm just getting salary which is fixed, but company is getting a lot of money. So company is really getting benefited. I'm not able to be a part of the growth, huge profitability what the company is experiencing. Such a thing may happen in the minds of employee. And what may happen? Employee may leave and search for another job. Maybe in the other job that person gives 20,000 more or 15,000 more and this employee may join another job. So friends, please understand, for the employer, that is the company, one of the most important or challenging things today is how do we retain talent? Imagine in Infosys, what is Infosys without their employees? Infosys is not computers, buildings, right? So it is basically those employees who make Infosys what it is today, because it is all about technology, it is all about people skills. So considering that, here you want right people to actually do the work and also make others do the work properly. So considering this, friends, it is really important that we have an interesting way to retain employees in our company. How do we retain employees in our company? Salary alone may not be the best way to retain the employees. So that is why, particularly for key people, what we may plan is we will give salary plus we will give something called as shares in the company. We will give shares in the company. Now look at this. The moment employee joins, if I just straight away give some shares to the employee, what if tomorrow employee leaves? So we will plan the shares in such a way that, imagine today the employee joins, say today is 1st of January 2018, today the employee joins. We will tell the employee, wait for 2 years, serve the company for 2 years. After you serve the company for 2 years, meaning say once you come to 18 is over, 19 is over, 1/1/2020. On that day, we will grant you options. We will grant you options. Grant options means what? Listen carefully. On that day, we will give you a letter saying, what an amazing employee you are, what a great job you have done. So, you will get these 5,000 shares of this company, not today. That is not on 1st of January 2020. Imagine we are on 1st of January 2020. So we have the employee has completed 2 years of service. This employee is now getting a letter from the employer. Congratulations, you are entitled to 5,000 shares of the company. Not today, but if you continue to work for 3 more years, if you continue to work for 3 more years or 2 more years, like that, at least 1 year period should be there. But if the employee works for a period of 1 year or more, which will be fixed between employer and employee, let us say for our discussion sake 3 years. So if the employee works for 3 years, then employee will be able to purchase 5,000 shares of this company, say at 10 rupees value. Maybe on that day the market value is 50 rupees. But the employee may have a chance to buy the shares at 10 rupees, 15 rupees, 20 rupees like this at some value agreed upon. Now concentrate carefully, friends. Employee joined on 1st of January 2018. Employee was granted options on 1st January 2020. The period from January 2018 to January 2020 is not relevant for this chapter. For this chapter, the date when employer gives a letter to employee saying, excellent work, we are giving you these options. We are not giving you shares today, we are giving you options. What is the option? If you work with us for 3 more years, then you will get entitled to 5,000 shares. That is the option what we are giving. So the option what we are giving today, the grant date, we call it as grant date. What is the meaning of grant date? The date when this letter is given by employer to employee, 1/1/2020 is the grant date. And 3 years, count 3 years, 21, 22, 23. On 1/1/2023, the employee will get the options, the paper on 1/1/2020, whatever was given. As per that, if we wait for 3 years, we can get 5,000 shares. So employee waited for 3 years. Then on 1/1/2023, employee can actually get those shares, 5,000 shares, by paying the amount given in the letter which was given on 1st of January 2020. So on 1/1/2023, employee can get those 5,000 shares provided employee continues to work with the company. Those 5,000 shares at, say, as per the letter what was given to the employee, it was written that each share, to get each share, you just have to pay 10 rupees, you will get each share. Like that it is written. So on 1/1/2023, if employee pays 10 rupees per share, employee will get those shares. Now tell me friends, is it compulsory that employee should continue with the company till 2023? Well, no compulsion. Employee can leave. If employee leaves, employee will not get that, that's all. But paper was given on 1/1/2020, no? That is conditional paper. That paper had a condition that, hey, congratulations. Congratulations not for today, congratulations for future. Congratulations from company side we are committing. Listen carefully. On 1/1/2020, what happened? Company gave a commitment and said, hey, we will give you, from our side we will not change our word, we will give you 5,000 shares at 10 rupees per share if you continue to work till 1/1/2023. If you don't, you will not get these. I hope you understood that. If employee feels that it is worth continuing in the company till that date, and if employee actually continues till 1/1/2023, then employee will have an option. Employee will have an option to purchase those shares at 10 rupees. Now, imagine we are on 1/1/2023. Is it compulsory that employee must buy? No. Employee may say, hey, I don't want these shares. Hurry, you waited till this long, why don't you take those shares? Employee may say, I don't want those shares, I don't have even 10 rupees to pay, or whatever the reason be. Employee may or may not get those shares. That is employee's option. But if employee says, hey, I was entitled to these shares, I am paying 10 rupees per share into 5,000, 50,000 rupees I am giving you, give me those 5,000 shares. If employee asks for those 5,000 shares by giving 5,000 into 10, 50,000 rupees, can employer say, no, I changed my mind, I will not give? Not possible. You understood that? So, because of the letter that employer gave on 1/1/2020, employer must give those shares to employee if the employee completes the 3 years period from the date of granting, right? So we understood about the, just the general overview of that. Now we will go into the deeper terminologies, meanings and all of that. Now let us go one step deeper. 1/1/2020 in our example is called as grant date. It's called as grant date. On grant date, what is happening? Employer is giving a letter to employee. What is that letter stating? That letter says, hey, I will give you 5,000 shares, it could be 5,000, 10,000, whatever, I'm just giving an example. These many shares on 1/1/2023, if you pay me 10 rupees per share, if you continue working with us till that date, and even if the market price on that day is something else, doesn't matter. You will get the share only at 10 rupees per share. From our side, we will not change our word. Like this, employer is appreciating the service of employee and employer is saying, good job, from 1/1/2018 till date you have done a good job. Now it's not complete. If you put this kind of effort for 3 more years, we will give you shares. Like this, employer is giving a letter, right? Now this letter what is given is called grant letter. It's called as grant letter. Who is giving grant letter? Employer is giving grant letter to employee. Very good. Now this is very similar to the kind of things what we also see in our real life. Our parents tell us sometimes, say we have completed our 10th standard, we have come into the 11th standard, our parents tell us, hey, do well in your 11th and 12th standard. If you get this much percentage, then we will get your bike at the end of 12th standard, something like that. So, or we will get you a mobile at the end of your 12th standard or 11th standard, whatever. So something like that. It is that, oh, you completed your 10th class or 10th standard, you came into 11th, very good. It's not over. Put good work over 2 more years. Then you will get entitled to that particular mobile or bike or whatever. So friends, this is the grant. This is the grant what is happening. Very good. Just to view it in a slightly dramatic perspective. Today on 1/1/2020, the letter what employer gave to employee just has a thing that you will get 5,000 shares if you continue working for 3 more years and if you pay 10 rupees per share on that day, which is at your option, you will get those 5,000 shares. That's what is written. Today, are those 5,000 shares active? No, they are not active. Those 5,000 shares are not active. So it is something like, today it is a dead paper. Today it is a dead paper. Is it going to be permanently dead? No, it is inactive now, but when will it get life? Once you come to 1/1/2023, this paper will get life, correct? So you have to wait for 3 years, then this paper will get life. Okay, very good. This 3 years period is called as grant period. No, this 3 years period, this is one of the common mistakes I keep hearing from students. It's not called as grant period. Grant is already given on 1/1/2020. This 3 years period is called as vesting period. What is it called? Vesting period. The meaning of vesting period is wait. It is like a waiting period. So this 3 years is called as vesting period, and if the employee has completed these 3 years, then this dead paper or inactive paper will suddenly get life. Understood? So if the employee completes this vesting period, then that paper will get life. Then another point, we spoke about 5,000 shares. So remember friends, in employee stock options, the number of shares that are being granted have to be prescribed, have to be given. And what is other point given? The employee will get share at 10 rupees. It could be 10, 15, 20, 30, whatever. That value will also be fixed in at the grant date as to, okay, look, this is the basis on which we will fix up the value. So it could be like some fixed amount. You will pay 10 rupees per share, 20 rupees per share, like this you can agree upon. Or another way in which it can be agreed upon is, well, on 1/1/2023, whatever is the market price, 20% of market price you will pay, half of market price you will pay. Like this, employer and employee can agree upon those terms and conditions. But whatever it is, in our example, I said 10 rupees per share has to be paid by employee. That 10 rupees per share that employee has to pay on in 2023 is called as exercise price. Exercise price means what? If the employee wants to get those shares, employee has to pay some money. The money that employee has to pay, what we agree upon, is called as exercise price. And friends, when will the employee really buy? Imagine the value what employee has to pay is 10 rupees. Now you came to 1/1/2023. On that day, market price of share is 7 rupees. Imagine, market price of share is 7 rupees. Now, if you show this paper, you can get it 10 rupees. If you don't show the paper and go into market and stand, you will get it 7 rupees. Will you show this paper and pay 10 rupees? Nobody is an idiot here, right? So, employees will not exercise that option because that option is not favorable. So, that is why I am using that word option, option. Employees will use that option only if it is favorable to them. If it is not favorable, ignore, that's all. So, friends, the important point is this. If the market price of share is 25 rupees, but exercise price is only 10 rupees, employee says, oh wonderful, on 1/1/2023, just by paying 10 rupees, I am getting something which is worth 25. Probably employee may give the 10 rupees and get those shares, right? So that's the point. Fine. So you understood the meaning of grant, you understood the meaning of grant date, you understood the meaning of vesting period. Now, after the vesting period is completed on 1/1/2023, I said suddenly this paper will get life. It means that option got vested. That option got vested. You have to understand these words. These words are important. So on 1/1/2023, that option gets vested. Very good. Option got vested. Now what? After the option gets vested, from that day, there will be a period. There will be a period. Say from 1/1/2023, we would have agreed upon maybe 1 year, something like that. We would have agreed upon 3 months, 6 months, 1 year. For that much period only, this paper which got life will have life. Meaning, it is not that, oh, we got this, we will exercise this whenever we want in life. No. From 1/1/2023, there will be something called as exercise period. Exercise period meaning employee got entitled to those shares, options got life, but there is certain period within which that should be exercised. There is certain period within which that should be exercised. So that is what we mean by exercise period. I am repeating, friends, what is the meaning of exercise period? The options which were granted on 1/1/2020 became active or got life on 1/1/2023. Excellent. The ones which got active or which got life on 1/1/2023, now there is a time within which employee should take decision. I will pay 10 rupees and get those shares, or I will not pay anything, allow that option to go. So that decision has to be taken by employee. Within how much time should that decision be taken? That period within which the decision should be taken by employee after the options get vested is called as exercise period. So let us say in our example, 1 year is the exercise period. When I say 1 year is the exercise period, from 1/1/2023 count 1 year. So that will be up to 31st December 2023. So on or before that day, the employee should have taken a decision and exercised the option. If the employee has not exercised the option, what will happen? The option will die down, meaning a dormant paper, an inactive paper got life on 1/1/2023. That life is not permanent. No one's life is permanent, right? So that life is only for that 1 year period, the exercise period. So within that exercise period, employee has to take a decision either to get those shares or let that option die down, because at the end of exercise period, that option will die down. So these are the important terminologies what you need to understand with respect to this chapter. Friends, the rest of the aspects of this particular chapter we will really understand properly only when we start solving the problems. Let us come to the first problem. Look at this. A company has its share capital divided into shares of rupees 10 each. So face value. Let's write all these points. Face value rupees 10. Then on 1st April of 2011 or 21, whatever, let us write that. On 1/4/11, whatever, it granted 10,000 employees stock options. Employee stock options, we call them as ESOPs. ESOP means employee stock option plan. Okay, so ESOPs at 40 is the exercise price, meaning employee should pay 40 rupees when getting these shares, when market price was 130. On this day 130 is the market price. Very good. Now options were to be exercised between 15th May 20 something like 22, okay, so and 31st 15th March to 31st. So look at this friends, this is something like this, 15th March x2 and 31st March x2, right. So totally this is a story given. Then what else? Employees exercised their options for 9,500 shares only. In this period what happened? Out of 10,000, 9,500 exercised, meaning 10,000 options probably could have become shares, but only 9,500 actually exercised, meaning 500 lapsed. Lapsed means they became invalid. Initially we thought 10,000, but only 9,000 got exercised, 500 got lapsed. Then next point, what else is given? Remaining options lapsed. The company closed its books on 31st March every year. Show journal entries. Excellent. Now when should we pass the journal entries? On the grant date should we pass the entry? No, there is no journal entry that we need to pass on the grant date. We need to pass journal entries whenever the accounts are getting closed, or if there is an exercise which happens, whichever is earlier. When are the accounts getting closed? Accounts are getting closed on 31st March. When is the exercise happening? Starting from 15th of March, exercise of options is happening. Very good. So friends, basically the first entry that we have to pass will be on 15th March, and then we will talk about 31st March. Right. Very good. Now friends, let us pass the journal entry on 15th of March. Calculate carefully. On 15th March, how many options became shares? From this date to 31st March. So in this period, how many options became shares? 9,500 options became shares into what is the worth per each option that has to be paid by the employee? 40 rupees has to be paid by the employee. So calculate friends, 9,500 into 40, that will be 3,80,000. 3,80,000 employee should pay. Then employee should pay. For 3,80,000 that the employee is paying, what is the worth of shares that we are giving to employees? The market price on 1/4 itself was 130. Well, we do not have the market price in this period, but we will assume, in the absence of any other information, we will assume that the market price is 130 only. So for 40 rupees employee is giving us, we are giving employee share worth 130. Listen carefully friends, for 40 rupees that employee is giving us, we are giving employee share worth 130. Tell me, leave about shares. Employee is giving you 40 rupees. You are giving something worth 130 rupees to employee. Is there a deficit of 90? That is a burden on the company, right? That burden on the company, is it cost or loss? Concentrate carefully. Logic has to be clear to you. You received 40 but gave something worth 130. That 90, that's definitely burden on the company. Is that cost to company or is that loss? It is cost to company. It is one of the costs that company should incur in order to retain employees. I am repeating that 90 rupees per share is one of the costs that company is incurring in order to retain the employees. So considering that, we will call it as employee compensation cost, employee compensation expense or employee compensation cost. So it is not loss, it is cost only, it is an expense only, it is not loss. If I say it is loss, it means we are suffering that without any benefit. No, it's not that we are suffering it without any benefit. Because of this, the benefit what we are talking about is, in this period we are finding a way to retain the employees, so we should view this as a cost, not as a loss. Very good. So friends, considering that, what is the calculation we should do? 130 is the value. Out of 130, 40 rupees will be paid by employee, 90 rupees is the expense that the company should debit to its P&L. It is the expense which company should debit to its P&L. So this into 9,500, this into 9,500, this into 9,500. But hold on, 130 is the total value of share, market value of share. But in this, do you know that the face value of share is 10 rupees only? Yes. So what we should in turn do is, in this 130 we will split 10 rupees and 120 rupees. 10 into 9,500 will be the face value of share and 120 into 9,500 will be the securities premium. I am repeating, this portion will be the face value, this portion will be the securities premium, this portion will be the employee cost, which in turn will go into P&L and it will get debited to P&L. And 40 into 9,500, this will be received by company from employee. That's it. Friends, one of the important points that I always want you to remember is this. Whenever you talk about journal entry, there will be one of the two sides of the journal entry which will always be easy. If you are receiving money, you know what you are going to debit or credit? Amount is coming in, bank account debited, that's all. So cash or bank debited, here we will write bank account debited because amount is coming in. Very good. Then you are issuing shares. When you are issuing shares, will you debit share capital or credit share capital? You will credit share capital. So just think about it, the easier ones in the journal entry first we should fix and then the others can be done automatically. Okay, right. So in a very simple manner, if only one share were to be issued, then like one option became a share. I will not talk about 9,500 first, I will just talk about one. Then what we would have done is this, we would have said bank account debited. With how much? We would have received amount. See, all this you are writing from company's point of view. You are not writing this from employee's point of view. So considering that bank account debited, how much money we would have received? 40 we would have received, right? Then we would have allotted share to equity share capital, 10 rupees only. To securities premium is for 120 and this 90 is employee cost, or we call it employee compensation expense, that will be debited with 90. Friends, if this logic is clear, what you will do is into 9,500, into 9,500, into 9,500, into 9,500. That's all. So that is going to be your final journal entry what you are going to write. Now you can write this in the fair work. Bank account debited. Bank account debited with what value? We already discussed that, 9,500 into 40, 3,80,000. Then employee cost, I said. I will now call it in the proper manner, employee compensation expense. Write down employee compensation expense account debited. With what value? Please calculate. 9,500 into 90, 8,55,000. Please do the calculation yourself, and then only then you should write that. 2. Equity share capital. 9,500 into 10, that is 95,000. 2. What is the next one? To securities premium. Securities premium. What is the amount of securities premium? 120 into 9,500, 11,40,000. That's it. Being allotment of shares for 9,500 options, rupees 40 exercise price, rupees 130 issue price. That's it. Now this employee compensation expense has to be charged off to P&L. It is an expenditure. At the end of the year it has to be charged off to P&L. So friends, just to be sure, what is the date when we pass this entry? This entry is passed somewhere between 15th to 31st of that particular year, 31st March of that particular year, right? Now the next entry is for employee compensation expense being charged off to P&L. Now friends, for that next entry, transferring anything to P&L, basically whenever you say P&L account is charged off with this, all such entries should be passed only at the end of the year. So on 31st March you will pass this entry. What is that entry? P&L account debited to employee compensation expense, entire 8,55,000. Being expense charged off to P&L. Now the question is this: should the entire expenditure be charged off to this P&L only? Friends, here you saw that in this period, which is from this date to this date, which fully falls within the same accounting period, to hold on or to retain employees during this period, we gave this kind of incentive. Anyway, as per Companies Act 2013, this problem may not be the most optimum one, because that is from grant date to that, for it to be vested, there should at least be 1 year time as per Companies Act 2013. Anyway, the problem is given and we are solving it. So this period is fully falling into the current accounting period only. That is why this entire cost of 8,55,000 should be charged off to the current period's P&L. So that is what we have seen. That's it. Now let's look at the next problem. ABC Limited grants 1,000 employee stock options on 1/4/2010 at rupees 40 when the market price is rupees 160. Right. Always for these problems it's important to draw a timeline. When you draw proper timeline, the problem becomes really easy. Right. So on 1/4/2010, let us say 1000 ESOPs. Exercise price, what is the exercise price? Rupees 40. What is the market price? Rupees 160, right? So what is the employee cost on this day? If you calculate, what is the employee cost? Employee cost is 120, because 160 minus 40, 120 is the employee cost. Very good. Then the vesting period is 2.5 years. Okay, calculate 1, 2, 2.5, something like that. So 31st March 11, 31st March 12, and something like 30th September 12. Okay, right. Now let this be 31st March 13. Very good. Now move on. What is given? Yeah, and the maximum exercise period is 1 year. Acha. So exercise period, vesting will be completed when? 2.5 years. At this point vesting will be completed. Exercise from vesting date for 1 year. So increase this. Say this is 30th September 13. Okay, right. So up to this date maximum employees have a chance to exercise it. We know the meaning of exercise period. What is the next point given in the question? 300 unvested options lapse on 1/5/2012. We are on 1/5/2012, and here what happened? 300 lapse. 300 unvested. Why are we saying unvested? Because the vesting will happen on 30th September of 2012, but we are on 1st May of 2012. On this day the options lapsed. Why will they lapse like that? Employee left the company, that's all. So employee would have left the company before completion of this 2.5 years. That is why those options would have lapsed. So some employees are still there, but some employees left the company. To the extent of 300 options, they got lapsed. Clear. Now what is the next point? 600 options are exercised on 36/2013. Okay, so 36, somewhere here 600 exercised. 600 exercised. Total how many? 1000. Out of 1000, 300 lapsed here, 600 exercised. Exercised meaning they paid that 40 rupees and got those shares. And what happened to 100? 100 vested options lapse at the end of the exercise period. So at the end, meaning on 30th of September 2013, we find that 100 lapsed. 100 lapsed. What is the difference between 100 which got lapsed and 300 which got lapsed? Something like this. Those 300 were not eligible to become shares still at that time. So 300, for those 300 shares, basically for those 300 options, the paper did not get life. So even before the paper got life, the employee left the company. But in case of this 100, employee continued, paper got life, the employee could have exercised those options, but employee decided for whatever reasons not to exercise those options. So 100 options, what we are talking about, basically employee got the right to exercise, but employee said I don't want, right? I hope you understood what I mean by that. Now what are we supposed to do? Pass journal entries giving suitable narrations. Now before we start writing the journal entries, should we write any journal entry on 1/4/2010? not required. On grant date, no journal entry. I am repeating, on grant date, no journal entry. Then what is the next date when we have to pass journal entry? Either financial year ending or exercise. Which is earlier here? Financial year ending is 31st March 2011. So considering that, we have to pass journal entry on this particular date. Very good. Now, we understood that the total cost is 120 rupees per option. 120 rupees per option. We are calling it cost. My question to you, can I write off entire 120 in the first year? No, that cost fully should not be written off in the first year. Why? Listen carefully to this logic. We are on 1/4/2010. By giving this option, by giving this grant paper, we are hoping that these employees will be with us till this 30th September 2012. So for 2.5 years, we want to lock the employee with us. For that period, we are giving this option. So this 120 cost what we are suffering is with an intention to retain the employee at least till 30th September 2012. So considering that, this 120 cost per option should be written off not fully in the first year, it should be written off over 2.5 years. I am repeating, this 120 cost should be written off not in the first year alone, it should be written off over 2.5 years. So it is a cost for 2.5 years and proportionately 1 out of 2.5. So in 2.5 there is 1 out of 2.5 should be written off in the first year, balance will be written off in the future years. That is the logic what we have to bear in mind, and now we will make a working note to actually pass that journal entry on 31st of March 2011. Alright, now let us make a working note for this. Let's call it working note 1. Simply each of these working notes will be for the dates when you have to pass those journal entries. So the working note is for 31st March 11, right? Now what is the journal entry that you have to pass? It is for the employee compensation expense. So let us list out all those items which constitute or which will be required for the employee compensation expense. Number of options. What is the number of options? 1000. Then what is the cost per option? Cost per option is 160 minus 40, which is 120. 120 is the cost per option. Then total cost for 2.5 years. What is the total cost for 2.5 years? 1000 into 120, it is 1,20,000. Then cost for 1 year. Cost for 1 year will be, you will write something like this. For 2.5 years, if it is 1,20,000, then for 1 year, how much? This will be 1,20,000 into 1 by 2.5, which will be 48,000. Calculate that. 1,20,000 by 2.5, 48,000. This is the cost for the first year, right? Now, you know the cost for first year. Based on this, you can pass the journal entry for first year. What will that journal entry be? Let us look at that journal entry. Friends, now 48,000 rupees is the cost for first year we calculated. Friends, are we paying anybody this 48,000 right now on 31st March of 11? No, we are not paying anybody. It is only a cost what we are accruing. If we are accruing cost, forget about employee compensation expense, ESOPs and all of that. Imagine it is like a salary for a moment. It is like salary payable to employee, salary expense debited 48,000. 2. Are we paying it today? No, we are not paying it today. It is payable it will be accumulated as a liability. So we will accumulate this also as a liability. Fine. So we will write one name and we will accumulate it as a liability. We will credit that liability. Fine. After that, the salary expense, will you charge that off to P&L? Yes. The same way, this employee compensation expense 48,000 will be charged off to P&L. Let us look into the journal entry as to what we are supposed to pass. We will write employee compensation expense account debited 48,000 to employee stock option outstanding account 48,000. I am repeating, employee compensation expense account debited 48,000 to employee stock option outstanding. You can simply remember this as a liability payable, right? 48,000. And then you will pass one more entry, P&L account debited to employee compensation expense to the extent of 48,000. Come on, let us now pass these entries. So write the entry, friends. On 31st March 11, we are passing this entry, employee compensation expense account. We should debit this with 48,000 to employee stock option outstanding account. $48,000 being expense for year 1 recognized working note 1. In working note 1, all those details are given. Then on the same day, P&L account debited 48,000 to employee compensation expense 48,000 being expense charged off to P&L. That's it. Great. So friends, at this stage we completed accounting entry as on 31st March 11. Now come to 31st March 12. Will anything change? No. Whatever accounting entry we have passed on 31st March 11, more or less similar entry we are going to pass as on 31st March 12. So let us actually look into the logic. How are we going to do it? Concentrate carefully. Freshly, you will assess what is the total cost required till this date, and you will check what is the portion which is already written off in the previous year, and for the balance you are going to provide or you are going to charge off in the current period. So we will understand this with the same logic. Totally how many options are there? 1000 options. And what is the cost per option? 120 is the cost per option. 1000 into 120, 1,20,000, and that is cost over how many years? 2.5 years. So how much period is completed? 2 years is completed. So 2 by 2.5 into 1,20,000 should have been charged off by now, means 96,000 should have been charged off by now. But how much is actually charged off till now? Only 48,000 is charged off till now. That is in the first year we charged off. In this period we charged off 48,000. But as we calculated, in this period, in 2 years period, we should charge off 96,000. Till now we charged off only 48,000. So how much extra should we charge off for this period? Extra 48,000 should be charged off for this particular period. So let us present this into a working note. So friends, on 31st March 12, right, number of options. Number of options 1000, cost per option. Cost per option is 120. total cost for 2.5 years, 1,20,000. Cost up to 31st March 12. Up to this date, how much should be charged off? Then you will say 1,20,000 into 2 years are completed, 2 by 2.5. 96,000 we have to charge off. But what did we charge off in the first year? We charged off 48,000. Write down. Less charged off up to end of previous period, 48,000. Then the difference, current period's cost. Current period's cost will be 48,000. That's all. So for this, now we have to pass the journal entries. So write the journal entry, 31st March 12. So the entry will be employee compensation expense debited 48,000 to employee stock options outstanding 48,000, right? Employee stock options outstanding 48,000 being expense for year 2 accrued or accumulated, whatever, working note 2, and then this expense should be charged off to P&L. Next entry, P&L account debited 48,000 to employee compensation expense 48,000 being year 2 expense charged off to P&L. Friends, what will happen to employee stock option outstanding account? It is like a liability, right? It's like a payable or liability. In first year 48,000 became payable. It was not paid or it was not settled. Then in second year 48 more became payable. So 48 plus 48, totally 96,000 must be outstanding in the employee stock option outstanding account, right? Now let us move to the next date. Friends, come back to the timeline. We completed the journal entries up to 31st March 2012. On 1/5/2012, there is some lapse of options. Unvested options got lapsed. Do we need to pass any journal entry for this? No, there is no need to pass any journal entry for this, and this will automatically get adjusted when you do the settlement at the end of the accounting period. So don't worry about that at this point. Now come to 30th September 2012. Anyway, I'm just going back to 1st of May. 300 options got lapsed. Do we need to pass an entry? You don't have to pass an entry for lapse of options. When you do the settlement at the end of the accounting period, that impact will automatically get adjusted. That's what I meant. Now on 30th September 2012, this is the date when the options got vested. Totally out of 1000, how many got vested? 700 got vested. Listen carefully, 1000 minus this 300, 700 got vested. So on this day we can say 700 got vested. Out of 700 which got vested, how many were exercised? Within the next 1 year, only 600 were exercised and 100 lapsed, right? 100 of vested options got lapsed. Very good. Now on 30th September 2012, should we pass any journal entry? You don't need to pass any journal entry on 30th September 2012. Basically, it is not an accounting year end, so you can as well pass the entry on 31st March 2013. Now friends, if the company were closing the books of account on 30th September 2012, meaning say half yearly accounts if the company is preparing, then probably that journal entry whatever I am going to talk about now, you might pass on 30th September 2012 itself, but nothing like that is given. So I am going to pass the journal entry on 31st March 2013. Okay, what is that journal entry going to be for? Today, what is the revised number of options? Revised number of options is only 700, 1000 minus 300, 700, 700 options. What is the cost per option? Cost per option is 700 into, okay, per option is 120. Per option 120 means total how much? 700 into 120, which will be 84,000. That is going to be the total cost, right? Total cost over 2.5 years is just 84,000. Acha, but how much did you provide till now? You provided 96,000 till now. You understand the problem? Till now, you already provided in year 1 and year 2 48,000 and 48,000. So cumulatively 96,000 you already provided for. But because of these options which got lapsed at the end of something like 30th September 2012 or even on 31st March 2013, we are saying, hey, totally you need to have cost only for 700 options. 700 into 120 will be only 84,000. 84,000 into 2.5 by 2.5, all the period is completed, so entire 2.5 completed, so 2.5 by 2.5, that is 1, so totally 84,000 should be the cost, but we have 96,000 cost. What are we supposed to do in such cases is what we are going to learn now. Now make the next working note. Working note 3. This is as on, you can say 30th September 2012 or 31st March 13. Okay, so one of the two, doesn't matter. Now at this point you are passing this journal entry, so or rather making this calculation based on which you will pass this journal entry. Number of options. What is the number of options still which are available and valid? Minus 300, 700, right? So 700 options are valid. Then cost per option. What is the cost per option? 120 is the cost per option. Total cost over 2.5 years, which will be 84,000. That is the total cost over 2.5 years. Then cost already incurred, 96,000. 96,000 you already debited, but today you realize cost is only 84,000. Now just imagine friends, if the total cost over 2.5 years was 1 lakh, then I would have said, hey, extra 4,000 you have to charge, extra 4,000 you have to charge as employee compensation expense. But that's not the case, it is opposite of that, right? We already have extra cost now, extra 12,000 we have. Then what are we supposed to do? For this, the treatment is given by the guidance note on employee stock option plans. Institute of Chartered Accountants of India has issued this guidance note. So based on that guidance note, we are going to pass this journal entry. Friends, concentrate carefully, there is something very important in this particular point. Extra cost of 12,000 should be reduced from employee stock options outstanding. See, that's the point. From employee stock options outstanding, you have to reduce this extra cost of 12,000. For that, write down the next point. It should be credited to general reserve not P&L. Mark this important. When you provided for that cost, when you accounted for that cost, you debited P&L. When you are reversing that, you are crediting to general reserve. So as I understand, probably one of the reasons why this would have been given like this is just because, you see, if you credit it to P&L, what will happen? Profit for the period will increase. When the profit for the period increases, EPS for the period will increase. Earnings per share will increase. So this can also have an impact in the share price increasing. So just because the company wants to increase the share price, they should not manipulate and make some employees leave the company, make them disqualified. Such funny things should not happen. So probably that is one of the reasons why you have this credited to general reserve, not to P&L. Right, very good. So this should be credited to general reserve, and now let us pass a journal entry to give effect to this. So friends, please write this journal entry. Let us just write for 31st March 18. Then what is the journal entry, friends? The journal entry will be employee stock option outstanding debited. It is not credited. Employee stock option outstanding is reduced from 96,000, we are bringing it down to 84,000. Debited by 12,000 to general reserve 12,000, being employee stock option outstanding reduced as per working note 3. That's all. Now there is no P&L impact here. You are not transferring it to P&L. You are crediting it to general reserve. Right? Now this is done. Let us go to the next date, that is 30th of June 2013. On that day what happened? 600 out of those 700 options got exercised. They got exercised, meaning employees gave money, they took those shares. All that happened on 30th June 2013. Let us make a working note and then we will pass a journal entry for it. Friends, now let us make working note 4. This is for 30th June 2013, whatever. Okay, right. Now here for this, what is the journal entry we are supposed to pass? Basically what has happened here, for 600 options, they will now become 600 shares. 600 options will become 600 shares. That is what is happening. Right. Now what will come in? Imagine for each option what will come in? Bank will be debited. Bank will be debited. For each option, if you just write, each option, bank will be debited with how much? It will be debited for each option. Bank will be debited with 40. Then 2, equity share capital 10. 2, securities premium. What is the securities premium? 160 is the price. 160 is the price means 10 is the face value, 150 is the securities premium. Then what is the differential? Differential is 120. This 120, concentrate carefully. This 120, should I separately debit to employee compensation expense again? No. This cost was already accumulated, something like this. We said accumulate, accumulate, accumulate. We went on accumulating, and that accumulated amount now we have to settle. We have to settle. So separately you need not recognize cost. That cost was already debited over 2.5 years, and that is what you are now going to settle. Sir, are you sure we accumulated it? We accumulated it. Look at the end of 2.5 years, what did we have as the total accumulated cost? 84,000, right? 84,000 for how many options? 700 options. Means per option how much we accumulated? 120 we accumulated, meaning we actually debited that to P&L over 2.5 years, and that cost is that amount of 120. So friends, employee stock option outstanding debited 120. That's the important point. You are not going to separately debit it to employee compensation expense here. Mark it important. You will debit it to employee compensation, employee stock option outstanding account. Very good. So this logic what we discussed here, let us apply into the problem. Now for how many options will you do this? For 600 options. For 600 options. Okay. Now if I do it for 600 options, look at this, employee stock options outstanding is 120 into 600, which will be how much? 72,000 only. But what is the amount which we accumulated? At the end of 2.5 years we had 84,000, right? But this is only 72,000. That balance 12,000 is the amount of vested options. That is 700 got vested, but only 600 got exercised. So they are those vested options which were not exercised. What do we do with vested options which were not exercised? We will charge them off to P&L. No, we will transfer them to general reserve. We will transfer them to general reserve. I hope you are clear about this. So for this, now let us start passing the journal entry. But remember, this exercise happened on 30th of June. But when will you transfer the 100 for those 100 options? 100 into 120, the 12,000 balancing figure I said will be transferred to general reserve. When will that be done? At the end of exercise period. Meaning you are saying, hey, 700 got vested. 700 all of them can get exercised, but only 600 got exercised. When were these 600 exercised? On 30th June they got exercised. So on 30th June we will pass entry for exercise of those 600 options, and for the balance 100 which were vested but not exercised, we will transfer that to general reserve, not on 30th June but on 30th September. Clear? Now we will pass journal entries for this. Friends, what is journal entry? On 30th of June 2013, the entry is bank account debited 600 into 40, that will be 24,000. Then employee stock options outstanding account debited, which will be 600 into 120, that is 72,000. 2. Equity share capital, how much will that be? 600 into 10, 6,000. 2. Securities premium, 600 into 150. 600 into 150 will be 90,000. That's all. Being allotment shares, being allotment of shares for 600 options vested and exercised. Right. Now for the balance 12,000 which we have to transfer to P&L, which we have to transfer to general reserve, what is the entry? When are we going to pass that entry? We are going to pass that after 30th September 13 is completed. So basically we have to complete that, or you may say on 1/10/13 we will pass this entry. What is the journal entry going to be? Employee stock option outstanding account debited with what value? 12,000. I may simply write this as 84,000 minus 72,000. This is the balancing figure, right? To general reserve 12,000, being vested options lapsed transferred to general reserve. That's it, right? These are all the points what you have to remember, friends. So friends, basically in employee stock options account, stock option outstanding, is there anything left out? No. 84,000 minus 72,000, 12,000 whatever is left out we transfer to general reserve. So employee stock option outstanding account is also closed. That's it. Friends, now let us look at the next problem. Arihant Limited has its share capital divided into equity shares of rupees 10 each. On 1/10/2011, it granted 20,000 employee stock options at rupees 50 per share when the market price was 120 per share. So exercise price 50, the employee compensation cost total will be 70 and the market price is 120. The options were to be exercised between 10th December 2011 and 31st March 2011. So this is the exercise period, right? Then 1/10 to 10 December. So that period will be called as vesting period, right? Employees exercise their options for 16,000 shares only and the remaining options lapsed. So well, out of 20,000, 16,000 exercised, 4,000 lapsed. Company closes its books on 31st March every year. Show journal entries with narration as would appear in the books of company up to 31st March 2012. Now, let us draw a timeline, friends. What is the date of grant? 1/10/11. Then, how many options? 20,000 options. Right. Then 50 is the exercise price, 120 is the market price, 70 is the cost. Right. Then continuing, options were to be exercised between 10th December and 31st March. So let me draw this. 10th December 11 and 31st March 12, right. So it's something like this is the vesting period, this is the exercise period. Then what happened? Here you notice that the employees exercise their options to the extent of 16,000 shares. So in this period, 16,000 of these options became shares and 4,000 lapsed. Right. Then that's it. You are supposed to pass the journal entries for these. Friends, here when would the first journal entry come? Will you pass any journal entry on the grant date? No, you don't pass any journal entry on the grant date. Then you will pass a journal entry on the financial year ending or at the exercise, whichever is earlier. Here the financial year ending is 31st March, but exercise is happening even before that. So we will have to pass a journal entry for this exercise. So first let us make a working note. So what is the working note? Let us call it as working note 1. This is from 10th of December 11 to 31st March 12, right. Then number of options. Friends, should I take 20,000 or 16,000? We know very clearly that the actual number of options which became shares are only 16,000. Imagine if this had happened maybe in May of next year, the exercise if it had happened in May of 2012, then probably cost calculation, best estimation would have thought, oh, 20,000 options we gave, maybe all 20,000 would be exercised. So we would have done probably the calculation with 20,000 options. But now you don't have that problem. You exactly know that the number of options which became shares are 16,000. So you can pretty much take this 16,000. Great. So number of options 16,000. Then what is the cost per option. Cost per option. When I say cost, I am talking about employee compensation cost. We just calculated, it is 70 rupees, which is the cost per option. Great. Now 16,000 into 70, total cost will be 11,20,000. 11,20,000. So that is, you can write 16,000 into 70. Great. Now friends, what we will do is, if you understand just what is the journal entry that you are going to pass, amount that you are going to receive, something like this. I am just writing this part in the rough work. This portion is the rough work. What is the amount you are going to receive per option? Bank account debited. Per option we will receive 50. Then what is the employee compensation cost account debited? Employee compensation cost is debited to the extent of 70. 2. Equity share capital to securities premium. Equity share capital with what value? Read the question. 10 rupees each, and securities premium will be for 110. That's all. Now your journal entry which will come into the fair work will be each of these into 16,000 into 16,000, like that. I hope you are clear about this. So for these many you will clear. Now the question is, should you pass a journal entry for transferring the employee compensation cost to P&L? Definitely yes, because that employee compensation of 11,20,000 what I am talking about is cost for this period, and this period is fully in this financial year only. So entire 11,20,000 should go into P&L. Very good. Now the next question. Should we transfer cost relating to those 4,000 options to general reserve? Yes or no? I think yes. Yes or no? No. Because if you have already created that cost, then you have to transfer that to general reserve. Here, at the time of making estimation itself, you did not make estimation for 20,000 for you to transfer 4,000 related cost to general reserve. You made estimation only for 16,000, because by the time you started making estimation, it was very clear to you that the actual amount is only for 16,000 into so and so. So friends, please understand, had the exercise period gone into next financial year, then probably we would have made the cost calculation at 20,000 options, and in the next year portion relating to 4,000 we would have had to transfer from employee stock option outstanding to P&L. So now you don't even have that. So it's very simple. See here in this problem, are you creating employee stock option outstanding? No, you are not creating. Why are you not creating employee stock option outstanding? It is something like this: expenditure for this period, paid in this period. Will there be a liability? No, that's all. If salary is for this period and if I pay off salary in this period, what will happen? There is salary account, salary expense debited to cash or bank, over, paid off. So there is no liability. This salary expense will go into P&L, P&L account debited to salary expense, which is fair. The point is, you will get liability if salary expense is for this period, but it is paid in the paid or settled in the next period. So friends, if the employee stock option is getting created, basically the cost is in this period, settlement is also happening in this period. When I say settlement, it is something like issuing shares and closing that. So settlement is also happening in this period, then you don't have to create any liability. And here when you are making the estimation, so friends, as I said, it is for this period, right? Now in this period, the best estimation of number of share options which may become shares, you don't have to take any guess here, you already know it is 16,000. Are you clear about that? Had we not known this, then we would have probably considered 20,000 and made an estimation. Here you don't require estimation, you can go with actuals, which is 16,000. That is why you provided for 16,000 related or 16,000 options related cost, and that entire cost you transfer to P&L. You don't have to create or you don't have to transfer anything to general reserve, because the cost calculation is not for 20,000 for you to transfer 4,000 related cost to general reserve. Friends, this point is important, and we solved different types of problems already. In some problems we saw transfer to general reserve, in some problems we saw employee stock option account getting created. You should know why we created that in those problems, why we are not creating those accounts in this particular question, right? Now let us pass journal entry, friends. Here on as I said, somewhere between 10th of December to 31st March, right, in this period, bank account debited. Bank account debited with what value? 16,000 into 50, which will be 8 lakhs. Then employee compensation expense debited. We already calculated 11 lakh 20,000. 2. Equity share capital 16,000 into 10. To securities premium, that will be 16,000 into 110, 17 lakh 60,000, being allotment of shares for ESOPs. The next entry would be P&L account debited 11 lakh 20,000 to employee compensation cost 11 lakh 20,000, being cost charged off to P&L. That's all. Friends, let's look at the next problem. This is quite interesting. We have to do calculations over 3 years. Ajanta grants 120 share options to each of its 460 employees. Let's make the calculation. 120 options for 460 employees. How many options will this come to? Take out your calculator. 120 into 460, that will be 55,200, right? So 55,200 options are under discussion. So here 55,200 options are under discussion, right? Move on. Each grant is conditional on the employee working for Ajanta over the next 3 years. Fair enough. So you only if the employees work for this company over 3 years, they will get those options, right? So that vesting period basically, right? Vesting period (3 years). So basically 3 years of continuous employment, right? Move on. Ajanta has estimated that fair value of each share option is 12. What does this mean? Friends, I want everybody to concentrate on this particular conversation. Fair value, intrinsic value. These are two important words what we are going to discuss with this particular problem. Imagine the question says something like this. Exercise price is 100, market price is 150. Then what would you say? Cost is 50. Cost to whom? Cost to company. Employee compensation cost you would say is 50. If you say cost is 50, it is benefit for somebody, right? Cost for company, benefit for someone else. 50 rupees of cost company is bearing, and who is getting benefited? Employee is getting benefited. So what is the value of benefit for employee? We will say this is the benefit for employee, right? This benefit is called as intrinsic benefit, or intrinsic value of employee stock options. It's called as intrinsic value of employee stock options. Very good. Now, if these papers, these grant papers have fair market value, if these grant papers have fair market value, see, intrinsic value we understood what it is, basically market price minus the exercise price, that is what we are calling as intrinsic worth of those options. Now, when I talk about fair value, this paper might be worth 50, but if I want to sell this paper, I get only 40 say, or if I want to sell this paper, I get 60. So, the fair worth of that paper is what is called as the fair value. I actually dumbed it down and tried making it very simple for you to understand, but advanced aspects about this you learn in your CA final. So, for now this should be sufficient. In CA final again you have a detailed discussion on this. So, friends, coming back here, the fair value of that could be 40, could be 60, could be 70 or whatever. So, that will be the fair value of that particular option. So, in this problem what is given? This Ajanta has those options and each option has a fair value of 12 rupees. Right, move on. Ajanta estimates that 25% of employees will leave during the 3-year period and so forfeit their rights to the share options. Friends, think about it. If an employee leaves in the next 3 years, vesting period is 3 years. Before the options get vested, if employee leaves, will that person get any shares? No, that person will not be entitled to any shares because the person left the company before the options got vested. So, here if such a thing happens, there is no question of you having to incur any cost around it. So, when in the very first year we want to make an estimation, hey, we are at first year, but at the end of 3 years, how many employees are expected to get benefited because of this? Meaning, what is our cost burden? Employees benefit is our cost, company's cost. So, what is company's cost going to be? If I talk about that, I don't have to provide for cost on 55,200 options, only 75% on that 55,200 only we need to provide for. I am repeating this point. We don't have to provide for cost on all 55,200 options. We need to provide only for 75% of 55,200 because best estimate we have to provide for. After all, this calculation involves that estimate of, hey, we are at year 0 or year 1, but at the end of 3 years, how many employees are going to get benefited or how many employees are going to exercise that. So, based on that we are today providing this particular cost. So, friends, here what you have to bear in mind is you don't have to provide for cost on all the 55,200, you need to provide for cost only for 75% of that because your best estimate of cost is 75% of that. Are you clear about this? Right, moving on. And so forfeit their rights. Everything turns out exactly as expected. Of course, it happens only in examination problems. Required, what are you required to do? Calculate the amount to be recognized as expense during the vesting period. Now, friends, let us do the calculation. Here, there is a 3-year vesting period. Year 1, year 2, year 3. Right. Now, what is the number of employees? 460 employees. And we said 120 options per employee, 120 options per employee, right. So, this we calculated to be 55,200, maybe all this can form part of your working note 1. So, 55,200 employee stock options, right. Now, do you need to provide on the grant date? No, you do not have to provide on the grant date, right. So, here at the end of the accounting period or exercise, whichever is earlier, you will have to make the first journal entry. Here, exercise is going to happen after this, but the first financial year ending is at the end of year 1. So, considering that, we have to provide for the first year cost. Now, imagine you moved from, say this is year 0, you moved from year 0 to year 1. You moved from year 0 to year 1. At year 1, that is end of first year, you are making the best estimate. So look at the thought process. I am at year 1, I am looking at end of year 3. Standing here, I am looking at the end of year 3, what is the best estimate of cost what the company might incur is what I am trying to calculate. I am repeating, I am standing at the end of first year. Standing here, I am checking at the end of year 3, what is the best estimate. See, today I don't know exactly what it's going to be, but as per today, what is the best estimate of the cost that we might have to incur at the end of year 3 is what we are trying to calculate. So as we see information regarding this, we realize, well, you will not have to worry about all 55,200, you will have to worry only about 75% of them, because 25% are going to leave the company. So only 75% would be relevant. Okay. And for that, what is the cost per each option? Cost per each option or value per each option, fair value. It's not intrinsic value here. Earlier problems what we solved were based on intrinsic value. Now it is based on fair value. Fair value is rupees 12. Fair value is rupees 12. Okay. Now this is the total cost. Okay. Quickly do the calculation. 55,200 into 75% into 12. 55,200 into 75% into 12. That will be 4,96,800. 4,96,800. Come back. This entire cost of 4,96,800, should I charge off fully immediately only in first year? No, this is cost over 3 years. This is cost over 3 years. Now what are we supposed to do? For 3 years, if this is the cost, for 1 year, for first year, how much is the cost? We need to do the calculation. Simply divide it by 3. Come back to this. Divide by 3. 1,65,600. So first year cost is 1,65,600. Now let us calculate this, friends. In year 1, what is the cost? Cost will be number of employees into options into value, option value we call it, right, into 1 by 3. Makes sense, because that entire cost should be divided over 3 years, right, over 1 by 3. Now what is the number of employees? Number of employees in this problem, 460 into what is the number of options per employee? Now, is it that everybody will be entitled? No, only 75% will be entitled, 75% of them, and option value is 12 into 1 by 3. So friends, these would be the number of employees that would be entitled to these options into 12 rupees, which is the option value, which is the fair value of option. 1/3 of that, because this is the cost over 3 years. For first year, how much is it? So that way we calculated that to be 1,65,600. This is the first year cost. Now I hope you made a note of this. Let us move into the second year. The way we do is like this. Say this is 1 year, this is 2 years. We will calculate total cost for 2 years, and then we will subtract from 2 years cost 1 year cost. Then what will you be left with? You will be left with the cost for the second year. Are you clear about that? So considering that, friends, what is the calculation for the second year? Look at this. You should not just change it like this, you should write it separately. In year 2, number of employees, options, 75%, all that is same. Option value also same, 12 rupees. It will not be 1 by 3, it will be 2 by 3, right? Minus whatever was charged in the first year, right? minus year 1 cost, minus year 1 cost. So this comes to, calculate that friends, what is the cost for this? The cost for this will be 3,31,200, twice of 1,65,600, that's all, minus year 1 1,65,600. Please do the calculation in your calculator. 1,65,600 is the annual cost and twice of that is the cost what should have been charged off up to the end of second year. From that, if you subtract the first year portion, you will be left with the cost which should be charged off to P&L in the second year, which will be 1,65,600. Are you clear about this? Right, very good. Now, if you come to third year, for 3 years, how much should be the cost which should be charged off to P&L cumulatively? We will calculate that. So 1, 2, 3, and then from 3 years cumulative cost, you will subtract how much should have been charged off for the first 2 years. That will give you how much should be charged off in the third year. So friends, let us do the calculation for third year now. In third year, this is a separate working note for you, right? In third year, again, number of employees, options, and 75% of that, option value, all that same. Instead of 2, it will be 3, right? Then, here, instead of 2, it will be 3, minus year 1 cost minus year 2 cost, minus year 1 cost minus year 2 cost. So basically the cost what we charged off up to second year. When I say up to second year, first year and second year both will be covered. Right, very good. So friends, calculate that. 3 times of this will be 1,496,800. Please do the calculation yourself. 1,65,000 into 3 is basically what it is, 4,96,800. This is 4,96,800. I am talking about this portion, minus year 1 cost, which is 1,65,600, minus year 2 cost, 1,65,600. Both are same, no? So considering that, year 3 cost is also 1,65,600. Now let's come to the next problem, friends. P Limited granted options for 8,000 equity shares of nominal value ₹10 on 1st October. Let me first draw the timeline. Okay, 1st October 10. Right, what happened on this day? 8,000 options. Grant date. This is the grant date. 8,000 options and exercise price 80 is the exercise price, 170 is the market price, so 90 is the employee compensation cost. Right, move on to the next one. Vesting period is 4.5 years. See, this concept is so simple. Examiner does not know how to confuse you. That is why examiner is giving some half year and all that only to confuse you. Anyway, you are all super smart, you will not get confused. So here 4.5 years. Let us calculate carefully 4.5 years. So first year, that is half year end will be 31st March 11, then 31st March 12, 31st March 13, 31st March 14, then that's it. Is there any period beyond that? No. So 31st March 15. Okay, right. So 1, 2, 3, 4 and this is half year. Okay, right. This is not, you know, the way you keep reading in papers, this is not to scale, but anyway, just you can understand this is half year, 1, 1, 1, 1. So totally from this date to this date is 4.5 years. So this date will be called as vesting date. Vesting date. Clear? This 4.5 years will be called vesting period. Very good. Now, what's the next point? 4,000 unvested options, 4,000 unvested options lapsed on 1st December 2012. You should be careful to identify that. Somewhere around this somewhere around this, some lapse happened. How many options? 4,000 lapsed. Okay, then continue. 3,000 were exercised on 30th September 2015. Okay, so I think that must be the exercise period. So somewhere around this, so vesting happened on 31st March 15. After vesting, exercise period starts. So in this period, how many were exercised? 3,000 exercised. Totally 8,000 options. Here itself 4,000 lapsed. Here 3,000 exercised. Balance is 1,000. Look at the question. 1,000 vested options lapsed at the end of exercise period. We don't know when that exercise period is ending. Maybe around 30th September itself, or maybe a day here and there. So 1,000 vested options lapsed. Now our ESOP is barabar. So we have for all 8,000 exactly what happened we are aware of. Past journal entries for above transactions. That's it. That's what we're supposed to do. Let's get started. Now friends, for this entire working what we have done, let us give a number. Working note 1. Okay. Working note 1 is more like the summary what we made in the form of a line diagram. Very good. Let us choose what all working notes we have to make. Should we pass any journal entry on 1st of October 2010? Not required. So the first journal entry will be on the exercise or end of financial year, whichever is earlier. So here you will have one working note. Let me call it working note 2. Okay. For that period you have to have you will have a journal entry. You also will make a working note. Then here there will be one more working note and one journal entry. I will call it working note 3. When lapse is happening, suddenly for lapse you will not pass an entry, but for the period immediately after that lapse, when the accounting year ending is there, at that time you will have one more calculation. So working note 4 I will call this, and then this will be working note 5. Then exercise, this I will call it working note 6. Totally 5 more working notes we have to prepare. First working note is the summary. So 5 more working notes we have to prepare. Let's get started with the working note 2, which is on 31st March 2011. Right, concentrate carefully friends. Number of options. As we stand at this point and think of, hey, at this point as we stand, how many people are likely to exercise the option on the end of the financial on the vesting date, that is 31st March 2015. Standing on 31st March 11, we are trying to visualize, hey, how many are likely to exercise the option on 31st March 15. Friends, this 4,000 lapse whatever happened, that was on 31st December 2012. We will not know that till we come to 31st December 2012. Please understand. So standing on 31st March 2011, we will not know that some lapsing is going to happen, some employee is going to leave us in about 1.5 years time or so. That we wouldn't know. So we would have thought, well, probably all 8,000 would be vested on 31st March 15 is what we would have imagined. Are you clear about this point or not? I am repeating friends, we would have imagined that in 2015 that all these 8,000 would probably become equity shares. Well, that's what we believe today. That is our best estimation. Based on that, we will arrive at a working note. Come on, look at how we are doing this. Write down working note 2, 31st. Right. Okay. Now, number of options expected to be vested and exercised on 31st March 2015 as estimated In exam you don't have to write all this, but just for you to understand the logic I am explaining in detail, or we are writing notes in detail. As estimated on 31st March 11. So standing at this point you are seeing, oh, how many do I think will become equity shares after 4 years. So like that you are trying to make a best estimation. So this is 8,000. Clear? Then value per option. What is the value per option here? Value per option we calculated is 90. So that is the intrinsic value of the option. 170 minus 80, that is 90 rupees is the value per option. Vesting period 4.5, right. Then vesting period completed is 0.5. Half year is only done, right. So I am saying 0.5 is the years. So this is also years, this is also years. So 0.5 years are completed, right. Now what are we going to do next? We will talk about something called as cost. Cost for current period. Cost for current period. Cost for current period will be 8,000 into, what is the value per option? 90 into, so this will be 8,000 into 90 will be the total cost, right. But what is the portion completed? So we are saying something like this. Okay, maybe just add one more sentence. Just calculate this. 8,000 into 90, 8,000 into 90, which is 7,20,000. For 4.5 years, if it is 7,20,000, for 0.5 years, how much will it be? 7,20,000 into 0.5 divided by 4.5. Write down. 7,20,000 into 0.5 divided by 4.5. So that makes it 80,000. Friends, 80,000 is the cost for the first accounting period, that is 31st March 2011, right. So like this we are going to do the working notes for all, and then we will put this information into journal entries. Now friends, we completed till 31st March 2011. Now let us come to 31st March 2012. Here 6 months completed, here 1 year completed. So totally how many months completed, or how many years completed? 1.5 years have been completed. Very good. We are at the end of 31st March 2012. Question number 1. Is there any change in the assumption regarding number of options? No. This 4,000 labs that happened is in this period. So there is no problem. So same 8,000 options are continued. Then cost per option, same. Very good. So what is changing? Well, nothing is changing, just that from 6 months we went to 1.5 years, that's all. So basically we can make working note 3. Come to working note 3. This is on 31st March 12, right? Come on. Options. What is the number of options? Options are same, 8,000. Then value per option. 90. Total cost 7,20,000. For 4.5 years, if it is 7,20,000, for 1.5 years, how much will that be? We have to make a simple calculation. That will be 2,40,000. And simply we are saying 2,40,000 is for 1.5 years. For year 2, you can say cost for year 2, 2,40,000 minus year 1 cost. Makes sense, because in year 1 how much was already charged off? 80,000 was already charged off in year 1. So here it will be 2,40,000 minus 80,000, which will be 1,60,000. Friends, let me just put this in a diagrammatic perspective for a moment. Here we are saying this is first year, this is second year. So year 1, year 2. This is 6 months, this is 12 months or 1 year, right? Now total cost for this period we calculated 1.5 years is 2,40,000. For first 6 months already we provided in the previous year, that is 80,000. For the second, that is the 12 months period, what is the cost going to be? 2,40,000 minus 80,000, 1,60,000. Are we clear about this? Right, very good. Now we can move into the third year. Now friends, come back to this timeline. We completed 31st March 2012 calculation. Now come to 31st March 13. In this year there is something special that happened. What has happened? This 4,000 units or 4,000 options lapse happened in this particular period, correct or not? So in the current period 4,000 units or 4,000 share options got lapsed. 8,000 minus 4,000, how many more are valid? Only 4 more thousand are valid. Now concentrate carefully. Say we are on 31st March 2013. Standing on 31st March 2013, if you try estimating, hey, as at 31st March 15, how many options are expected to become shares? Well, the best estimation at this point what you can make for 31st March 15 is 8,000 minus 4,000, 4,000 more options. Are you clear about that? So now you need to revise your calculation. Right. Now let us think of how such computation is supposed to be done. Look at this point, friends. When did these options get lapsed? These options got lapsed at 30th. Look at this calculation. When did they get lapsed? They got lapsed on 1st December, right? So on 1st December, yeah, on 1st December they got lapsed. So now we are supposed to make a calculation as to for this third year how the cost has to be ascertained, and for these lapse of options how we have to consider. All this we are going to learn now. Working note 4. Totally how many options were there? There were 8,000 options. And till the end of second year, how much cost did you calculate and provide for? Till second year we provided for rupees 2,40,000. I am not saying in second year, till second year. So first year plus second year put together we provided 2,40,000. Now first thing first, can I say that this can be divided into two parts? 4,000 options had a cost which we provided 1,20,000, and 4 more thousand options had a cost of 1,20,000. Makes sense, right? There were like two bags, 4,000, 4,000. Cost of this is 1,20,000, cost of this is also 1,20,000. These got lapsed. These are still active. Okay. Now, if these got lapsed, what we should do is this entire cost should go into general reserve. I don't have to explain this point to you again. This we learnt already in the past. This entire thing will be transferred to general reserve from employee stock options outstanding account. I am repeating, this 1,20,000 will be transferred to general reserve from employee stock option outstanding account. And what about these 4,000 options which are still valid? Well, we have to provide for the cost in third year, because 2 years cost is already provided, third year cost has to be provided. So let's do the calculation. Third year cost we are providing, remember, only for these 4,000 options which are active on 31st March of 2013. Right. Now let us make the calculation. Options. What is the number of options? 4,000. Value per option. What is the value per option? 90. Total cost. Total cost is 4,000 into 90, which is 3,60,000 for 4.5 years. If it is 3,60,000, for how many years are completed now? For 2.5 years, how much should be the cost is what we will calculate. Do that. 3,60,000 into 2.5 divided by 4.5, that comes to 2 lakhs. Now, what is the amount which is already provided for? As we enter this year, already 1,20,000 was provided for. Very good. So, cost, I am just drawing a timeline so that it will be easy for you to understand. Up to 2.5 years, the cost that should have been provided is 2 lakhs. But till 1.5 years, the cost that was actually provided on these is 1,20,000. That's it. There lies your answer. So in this period, how much cost should be provided? 80,000 should be provided in year 3. 80,000 should be provided in year 3. When I say year 3, I am talking about this financial year ending 31st March 2013. We have to provide for an extra 80,000. I hope you are clear about the logic. I will repeat this at the cost of repetition. Please pay utmost attention. It's an important logic. Till 1.5 years, we provided for all 8,000 units or 8,000 options, we had 2,40,000. So that we split into two parts, 4,000, 4,000. For 4,000 options, the cost was 1,20,000. For the other 4,000 also 1,20,000. Then what did we do? This 4,000 we said lapse. Because they got lapsed, we transferred that entire 1,20,000 to general reserve. From where? From employee stock option outstanding. Excellent. Now come to these 4,000. For these 4,000 options, are they still valid? Absolutely yes. Because they are valid, you have to provide for cost. Cost for which period? Cost for this 1 year, that is beginning of 2013, that is 1/4/2012 to 31st March 2013. So for this 1 year, you have to provide for extra cost. How much? How do you decide that cost? We just did the calculation. 4,000 options into 90 rupees per option, that will be 3,60,000. For 4.5 years, if it is 3,60,000, for 2.5 years, how much should be the cumulative cost? That's what we calculated. That came to 2 lakhs. Correct? Now, then we said 2 lakhs should be the cumulative cost for 2.5 years. For 1.5 years, what was the cumulative cost? 1.2 lakhs. So the difference 80,000 is the cost which we are going to charge to P&L in year 3. Let us just write that point. Cost for financial year ending 31st March 2013 is 80,000. Great. Now friends, we completed till 31st March 13. Now come to 31st March 14. Between 13 and 14, are any assumptions changing? No, assumptions are not changing. Clear? So assumptions are not changing. You just have to provide for cost for this extra 1 year. So all that you are going to do is this extra 1 year cost you are going to provide. Other than that, assumptions are not changing. So let us see how we do that calculation. We obviously know if assumptions are not changing. Cost for this period also is going to be 80,000. But anyway, let us actually present it properly. This is 4. This will be working note 5. Yeah. Then this will be working note 6. This will be working note 7. Okay. So now come to working note 5. Friends, working note 5, this is on 31st March 14. Then options. How many options will you talk about? You will talk about 4,000 options only. Then value per option, this is 90. Total cost is 3,60,000. So we would say for 4.5 years it is 3,60,000. Then for 3.5 years which got concluded, how much should be the cost? That's what we will calculate. So calculate that cost, friends. 3,60,000 into 3.5 divided by 4.5. Please run this calculation on your calculator. How much is that coming to? That is coming to 2,80,000. So simply the way we have done earlier, we can say till 2.5 what was the cost? Till 3.5 years what is the cost? Till 2.5 years what was the cost? 2 lakhs was the cost. We calculated some time back. At the end of 3.5 years, how much should the cost be? 2,80,000. Then in this year, obviously the cost must be 80,000. So you can write cost for financial year ended 31st March 14 is 80,000. Right. Now in similar lines, you can calculate even for 31st March 2015. So let's calculate that also. Working note 6, 31st March 2015. Okay. Right. Now options, same point. I mean, like answer is going to be same, but I am just writing options. How many options? 4,000 or 8,000? 4,000 options. Then value per option. Value per option is going to be how much? Value per option will be 90. Then total cost. Total cost will be 3,60,000. For 4.5 years, it should be 3,60,000. Then how many years are completed? All the 4.5 years are completed. So for 4.5, how much? It's a stupid calculation. It's going to be of course 3,60,000 only. Now we are going to make that line diagram. So we are saying up to 3.5 years we got the cost to be 2,80,000. That is from the earlier working note. Till 4.5 years, how much is the cost coming to? 3,60,000. So in this period, what is the cost? 80,000 is the cost in this period. So cost for financial year ended 31st March 15 is 80,000. Friends, these are the workings till the vesting date. Now you have to talk about two more entries. What are those two entries? Exercise date, when actually they became equity shares, and for the portion where they were not exercised, when they got lapsed, you transfer to general reserve. So these are the two entries what you should now talk about. That will be your working note 7. Friends, now we came to 30th September 15. On this date what happened? Actually those employees exercised their option and they got their shares. How many options became equity shares? 3,000 of them exercised and they became equity shares. What happened to the balance 1,000? Till the exercise period ended, they never exercised it. So 1,000 of vested options got lapsed. Perfect. Now let's talk about these 3,000. For these 3,000, what is the amount that employee would have paid to the company? 80 rupees per option employee would have paid to the company for that option to become equity share. Makes sense? Perfect. Then what is the cost for company Per each option converted into equity share, 90 rupees. We already calculated that. So 80 debited, that is bank account debited 80 for each share, right? So bank account debited 80, then employee compensation cost. Is it employee compensation cost? No, it is not employee compensation cost. How many times will you freshly create cost? Already you created cost, you debited cost in those respective periods and accumulated all of that in that payable or settlable account, which is employee stock options outstanding. So basically friends, employee stock options outstanding should be debited to the extent of 90 to equity share capital. Well, should I write entire 170? No. Equity share capital 10, securities premium 160. This is the calculation per each share. Now, when we pass journal entry, what we have to bear in mind is this into 3000 for each of those numbers will be the journal entry what we are going to pass. We will make a small working note and that will make sure we pass the journal entry correctly. Now, friends, working note 7. So, simply as I said, bank account should be debited to what extent? I am talking about per share, the calculation should be debited to what extent? 80. Then employee stock option outstanding should be debited to what extent? To the extent of 90. To equity share capital to what extent? 10. To securities premium to the extent of 160. And in your journal entry actual answer, what will you do? Each of these into 3000 you will be doing in your journal entry. Now friends, the last point as a part of that working note 7 is regarding the transfer from employee stock option outstanding to general reserve. For that, let us look at a simple calculation. Till or at the end of 4.5 years, we had an amount of 3,60,000 in the employee stock option outstanding account, correct or not? We accumulated this cost every year, something we added and accumulated for 3.6 lakhs in the employee stock option outstanding account. Simple calculation what I want you to do is this. For how many shares? 4,000. If we created 3,60,000, then 3,000 how much? 1,000 how much? We are just breaking it up into what is the portion attributable to 3,000 and what is the portion attributable to 1,000. Portion attributable to 3,000 will be 2,70,000 and the one attributable to 1,000 will be 90,000. So friends, this 2,70,000 would be debited in that journal entry what we discussed, right? So when I said employee stock option outstanding account will be debited, right? To what extent? To the extent of 2,70,000. And what will happen to this 1,000? That is 1,000 into basically all of that, 1,000 into 3,60,000 divided by 4,000. So to the extent of this 90,000, you will transfer the balancing figure in employee stock option outstanding account into general reserve. So what is the entry for that going to be? Employee stock option outstanding account debited to general reserve to the extent of 90,000. Friends, that's about all the working notes. We discussed these logics even in the earlier problems, but in this problem we saw it more comprehensively for multiple years. I want you to pause the video for a moment and I want you to prepare the solution for this particular problem. Take 5 minutes, no problem. Write the journal entries, write on your own. See, don't have that fear of, oh, what if I make a mistake? It is good to make a mistake in your notes than making a mistake in your examination paper, right? So have that courage, write those answers, and then in 5 minutes time you resume this video and you can cross check what your answer is. So what you're going to do now is neatly the way you are going to write in your examination. There should be date column, particulars column, debit amount, credit amount, all of that, and neatly write the journal entries with narrations for all these periods. Simply you have to look at our working notes. From working note 2 to working note 7, you have to look at all those, and based on that you have to write the journal entries. I hope you will do that, and in about 5 minutes time you can come back and check the answer. So let's look at the journal entries, friends, in the books of this P Limited. 31st March 11, employee compensation expense account debited 80,000 to employee stock options outstanding 80,000, right. Then you are writing the narration also, being employee compensation expense for 6 months recognized. Then what is the next entry? P&L account debited to employee compensation expense to the extent of 80,000, you are transferring that to P&L and charging it off. Of course, that 80,000 employee stock option outstanding, it's a liability, it will carry on into the next year, which will have an opening balance in next year of 80,000. Then come to 31st March 12, again employee compensation expense debited 1,60,000 to employee stock options outstanding. This is coming from working note 3, right, being employee compensation expense for year 2 recognized, and you can give reference to working note 3. P&L account debited to employee compensation expense 1,60,000. I hope you solve these on your own and you are cross checking. Then now come to third year, employee compensation expense account debited 80,000 to employee stock options outstanding 80,000. This is for those 4,000 shares or 4,000 options for which you created fresh cost, and then P&L account debited to employee compensation expense to the extent of 80,000, being expense transferred to P&L at year end. Now what about those 4,000 units which got lapsed? You have to transfer that to general reserve, pass an entry for that. Employee stock option outstanding account debited 1,20,000 to general reserve 1,20,000, being employee stock option outstanding transferred to general reserve to the extent of shares or to extent of options lapsed, right. Now come to 31st March 2014, employee compensation expense account debited 80,000 to employee stock option outstanding 80,000, and P&L debited to employee compensation expense account 80,000. I hope this is correct. Then P&L account debited to employee compensation expense 80,000, when you do that, employee compensation expense for 2014 is getting charged off to P&L, right. We solve problems like this. This, if you have solved on your own, it will be a good practice. Now finally coming to 31st March 2015, in 31st March 2015 you would have again recognized 80,000 of expense and charge it off to P&L. So employee compensation expense account debited 80,000 to employee stock options outstanding 80,000, and P&L account debited 80,000 to employee compensation expense 80,000. The last entry will be, oh well, not last but one, will be for the exercise of options. So bank account debited, this will be on 30th September 2015, bank account debited 3,000 into 80, 2,40,000, employee stock option outstanding account debited 2,70,000 to equity share capital 3,000 into 10, 30,000 to securities premium 3,000 into 160, 4,80,000, being 3,000 employee stock options at an exercise price of rupees 80. The last entry will be to transfer the employee stock option outstanding to the extent of vested options which got lapsed. We have to transfer that to general reserve. What is the entry for that? Employee stock option outstanding account debited 90,000. This is coming from working note 7 to general reserve 90,000. Let's get started with the next problem. Choice Limited grants 100 stock options to each of its 1,000 employees on 1/4/2011 for rupees 20, depending upon employees at the time of vesting of options, right. So 100 options to each of its 1,000 employees. So totally how many options? 100 into 1,000, 1 lakh is the total number of options. And what is the next point? For rupees 20, for rupees 20 meaning the option can be exercised at rupees 20, exercise price is 20. Options would be exercisable within a year it is vested. So we understood this point, friends. There will be grant date, there will be vesting date, and from the vesting date, within 1 year, it has to be exercised. What will happen if it is not exercised within 1 year? It will be lapsed. Vested option will be lapsed. Right. Move on to the next one. Market price of the share is rupees 50 each. 20 is the exercise price. 50 is the market price. So what is the worth of option? 30 rupees is the worth of option. So worth of option is the benefit to employee and cost to company. Great. Move on. These options will vest at the end of year 1 if the earning of choice limited is 16%, or it will vest at end of year 2 if average earning of 2 years is 13%, or lastly it will vest at the end of third year if the average earning of 3 years will be 10%. Very smart company. Hurry, come on, tell me, why should somebody be given stock options only for just being in the company? You have to be in the company and you have to help the company perform, is how Choice Limited is looking at it. So it's not just being in the company and doing some bad job. No, it's not that. So actually, if the company does well and there is a percentage 16, 13 and 10, so like that you have 3 slabs. Now let's discuss this point carefully, friends. Say we are at the end of first year, we will check at the end of first year, is the company's profitability percentage, profitability only, right? So earning of Choice Limited, if it is 16%, then what will happen? That's the moment when the options get vested. From that day, within 1 year they have to get exercised. That is the logic. Now what if they don't get vested at the end of first year, but based on our estimation at the end of first year regarding the expected performance next year, if we feel, hey, even though it did not happen now, it might happen at the end of next year, then what we will do is, we will consider that the vesting period is 2 years. Very commonly we notice this. We make an examination preparation plan. I think you do, right? Now when we make that examination preparation plan, we make a very serious aggressive plan. By say end of December, we have to complete these 4 subjects. Now, well, if we complete, fantastic. If we don't complete, then maybe there are 2 more subjects which we should have completed during January. We would tell, oh, otherwise by January we should complete those 4 plus 2, 6 subjects. So basically what is happening? You are trying to roll forward your target and saying, ideally this should be done at the end of first year. If it is done, vested. If it is not done, then at the end of second year there is a next chance. If that target is met, it will get vested at the end of second year. Well, if that target is also not met, then go to the third year. That is the last. If certain target, the 10% target is met at the end of third year, then it can be vested at the end of third year. Let us now read further to understand what happened in the company. Then what does the question say? 5,000 unvested options lapsed on 31st March 2012, 4,000 unvested options lapsed on 31st March 2013, and finally 3,500 unvested options lapsed on 31st March 2014. So basically 5,000, 4,000, 3,500, something like this we already saw in the past, right? So totally 12,500 options lapsed, unvested options lapsed at different points of time. Totally how many options do we have? 1 lakh. And how many got lapsed even before they got vested? 12,500. Move on. The following is the earning of Choice Limited. Right. Recall, when were the options granted? 1/4/11. Now, as on 31st March 2012, earning percentage is 14. Now, what was the target? 16 was the target. What is actuals? Actuals is only 14. So, at the end of first year, as we stand, can we say that our first target was met? No, first target was not met. Because the first target is not met, will you say, oh, never will these options be exercised? No, you don't say that, because we are optimistic, right? So first, at the end of first year it is not met. Immediately the employees would say, hey, no, fine, at the end of second year we will meet. So at the end of first year, your thought process will be, even though the option vesting condition is not met today, we believe that the condition would be met at the end of second year. Then what will happen? Suddenly we would say, Option related cost. Option related cost. What is the cost? 50 minus 20, 30. We would plan in such a way that this cost should be divided over what period? It should be divided over the vesting period. So standing at the end of first year, what is our best estimate of vesting period? We will make an assumption that 2 years must be the vesting period. Chartered accountants, concentrate carefully on what I am talking. At the end of first year you are passing this entry, you are not passing this entry at the beginning of first year, because see, at the beginning of first year we would have thought, oh sure, maybe in the first year itself we will meet the target, but you are not passing the journal entry at the grant date. When are you passing the journal entry? At the exercise or end of financial year, whichever is earlier. Which is earlier here? End of financial year is earlier. What is the financial year ending? 31st March 12. So on this day you are passing the journal entry. When you are passing the journal entry on this day, the important point what you are looking at is, sure, the cost per option is 30 rupees, but over what period should we divide this? Over the vesting period. What is the vesting period? Can we say 1 year is the vesting period? No, because clearly 16 was not achieved, only 14 was achieved. So we cannot say that it is 1 year. Then had it been in the first year 17%, right? Actually what we have achieved is 17%. Then what would have happened? Of course, 16 or anything more than that, the entire thing would have become exercisable, or it would have been vested in the very first year. So entire cost of 30 rupees per option you would have charged off to P&L in the very first year. But that did not happen. That did not happen. So what actually happened? In first year it was not vested. So at the end of first year you will make a best assumption that, well, maybe it will take us 1 more year and hum honge kamyab. So it is not that you would assume that we will not get to the target at the end of second year. So you will assume by the end of second year we will achieve the target. So you will divide that cost over 2 years. Now listen carefully. The reason why the story around the problem is important is only then will you appreciate the logic. Otherwise it is just solving, right? Come on, move around. Move on to the next point. 31st March 2013, 10%. Look at this. What was our target? First year 16%, second year 13%. 13% was the target. But what is the average of 2 years? 14 plus 10 by 2, 12% only. So now say you came to the end of second year. At the end of second year, can we say that we achieved the target? We have not achieved the target at the end of second year. Friends, I hope you are understanding this point. We are standing at the end of second year now. We moved on to the end of second year. At the end of second year, we noticed the average of return. What we actually earned is 14 plus 10 by 2, which is 12%. 12% is what we earned, but the options will get vested if we earn at least 13%. That we didn't achieve. Then what to do? Well, same thing what you did in the first year you will do at the end of second year. At the end of second year you will believe, well, even though unfortunately we could not achieve that at the end of second year, probably we would achieve that at the end of third year. You get that point? So you would assume that it would happen, that vesting would happen at the end of third year. Now listen carefully, friends. 30 rupees is the cost. 30 rupees is the cost. What did we originally plan? We thought that at the end of first year, maybe 2 years is the vesting term, and you divided and said half of that will go into P&L in the first year. Now you are at the end of second year. At the end of second year, the important change is the vesting period is not 2 years. You revise the vesting period to 3 years. Chartered accountants, listen carefully. I am repeating this point. At the end of first year, you thought that the vesting period is 2 years and you wanted to divide the cost over 2 years. But at the end of second year, you realized that the vesting condition is not met yet and there is one more chance. At the end of third year, we may hit the target. So at the end of second year, you will make the vesting period to be 3 years. One more year will get added and that cost should be divided based on a 3-year calculation. So at the end of second year, when we do that working note, all these points have to come into your mind. So 2/3 of the cost based on the number of options after they got lapsed, that should have already been charged off till the end of second year. Then you will check what is already charged off in the first year, and then you will decide. So friends, I hope you got the logic around it. And finally, what happened in the third year? 7%. 14 plus 10 or 24 plus 7, 31. So what is the average? 10%. Because the average now at the end of third year is 10%, check. Did we meet our target, third year target? Yes. 3 years average, if it is at least 10%, we can say that our target is achieved. Excellent. So at the end of 3 years, the options get vested, and well, what is the next point? 850 employees exercised their vested options within a year, and remaining options were unexercised at the end of contractual life. So you understand as to what we mean by options being exercised. For that, we need to pass a journal entry. If they are vested but not exercised, as you know, we would transfer that to general ledger. I hope the problem is clear. Now what are we supposed to do? Pass journal entries for the above. Let's do that. Now friends, let's get started with journal entries. Of course, before journal entries, what we are supposed to do is just we'll draw a small timeline so that we have clarity on where we are in terms of our journal entries. Come on, get started. Please draw a timeline. You should do this in your notes as I draw it here. So when is the starting? The starting point is 1/4/11, and then when is this ending? 31st March 2014, and 1 year from there. Okay, so this is 31st March 2014, and this is the vesting date, ultimate vesting date actually, and this became the exercise period. 1 year. 31st March 2015. Right. Then (12, 13, 14). Right. Okay. Now how many employees were there? 1000 employees. 100 options per employee. What is the exercise price? 20 is the exercise price, 50 is the market price, 30, the difference between the two, is employee compensation cost. Basically, there is a cost to company. Right, move on. What is the actual earning? Actual earning 14%, actual earning here is 10%, and this is 7%. Average earning 14%. Here will be 14 plus 10 by 2, 14 plus 10 by 2, which is 12%, and here it will be 14 plus 10 plus 7 by 3, which will be 31 by 3, 10.33%. So these are the average earnings. Right, move on. 5,000 unvested options lapsed on 31st March 2012. Lapse 5,000. Then what is the next one? 31st March 13, how many lapsed? 4,000, and then 3,500. Okay. Then towards the end you have something like this. 850 employees exercised, and that point as we calculate, then we will write down exactly what is the number of employees and all of that. So, but there are actually some more vested options which got lapsed. About that we will do the calculation later. Right. Now, what are all the journal entries that you are supposed to pass? Do you need any journal entry for the grant date? No. So, just give a working note, one for the timeline. Okay. Now, when is the first journal entry going to be? this date. So, let us have working note 1 for this date. Second entry working note 2, then working note 3. Then you need during exercise period working note 4, and based on working note 4 we would actually pass multiple entries, one for exercise and the other one would be for cancellation or basically transferring the employee stock option outstanding relating to vested options which got lapsed to general reserve. For that we need to pass a journal entry, right? Great. Now let's get started with working note 1. Now working note 1. This is made on 31st March 12. Right. Now first thing, total number of employees as on 1/4/11,000. Then options per employee, options per employee 100, total number of options one into 2, 1 lakh. Then number of unvested options lapsed. How many got lapsed as per the information that we have? 5,000 got lapsed, right? So 95,000 is the number of options which, as we stand on 31st March 2012, we believe would be vested. So best estimate of options that would be vested. Best estimate of options that would be vested is 95,000. Then cost per option. Cost per option is 50 minus 20, which is 30. Cost per option is 30. Then based on this, total cost. What is total cost? 5 into 6, basically 95,000 into 3. So 9,000 into 27,000 plus this 28 lakh 50,000. Just calculate that yourself. 28 lakh 50,000 is the total cost. Just do the cross checking. 95,000 into 30 rupees, which will be 28 lakh 50,000. Now friends, read the question. Based on the information what we have at the end of first year, will the options get vested at the end of first year? No. But let us write that working note carefully in a detailed manner. See, I will tell you one simple point what you have to bear in mind when you are making a working note. Don't assume that examiner knows the answer. Examiner knows the answer perfectly well, but you should write the answer in such a way that even if the examiner does not know the answer, in the most easy manner, step by step manner, neatly, carefully we should understand, oh, this is how the logic moved from this point to this point to this point. So that should be really clear. And friends, based on that, total cost we know, vesting period. Vesting period. For this vesting period, I would want to write some notes. Come on, write down. What is the point regarding vesting period? As earnings percentage of first year is 14%, which is not greater than or equal to 16%, right? Options cannot be vested in 31st or on 31st March 12, right? That is the first point. Then what is the next one? Even though they are not vested as on 31st March 2012, you would believe that they might be vested at as on 31st March 2013. Write down. It is assumed that they would be vested on 31st March 2013, implies 2 years of vesting. 2 years of vesting. Are we clear about that? Right. Now, write the next point. Total cost should be divided over 2 years. Total cost should be divided over 2 years, implies cost for 31st March 2012 is equal to, total was 28,50,000. 28,50,000 into 1 by 2, which will be 14,25,000. Friends, are we absolutely clear about this, right? So, we calculate the total cost and we understood that the vesting cannot happen as on 31st March 2012 because that condition was not met, and we realized that, or we made an assumption that probably the vesting would happen by 31st March 2013, and for that we said if 2 years cost should be 28,50,000, 1 year cost should be how much? 14,25,000. That's your year 1 cost. Now come to the next one, working note 2. This is as on 31st March 13, right? So actually what happened on this day, what assumptions remain, what changed, let us just look at those. Number of options. I am not writing employees, all those points. Now let us start from number of options. Number of options as on 31st March 12. I am starting from there and making adjustment for those which got lapsed now. 95,000 less unvested options lapsed as on 31st March 13. This is 4,000. So that brings this down to 91,000. Number of options expected to be vested, 91,000. Cost per option. Cost per option anyway, that is 30 rupees, 50 minus 20, 30 rupees. So total cost, so this is 1 minus 2 and here it will be 3 into 4. So it should be 91,000 into 30, which will be 27,30,000, right? 27,30,000, that is the total cost, right? Now let us write the story regarding the period over which this has to be vested. Actual average earning over 2 years. Go and refer to working note 1. In working note 1, we have done that calculation. What is the actual average earning? 12%. Right. Then, as 6 is not greater than or equal to 13%, because that 12% is not greater than or equal to 13%, options will not be vested as on 31st March 2013. Is this clear? Right. So, they will not be vested. Had that condition been met, then they would have been vested as on 31st March 13. Right. Write the next point. It is assumed that they will be vested as on 31st March 2014, implies 3 years, implies 3 years. Then cost to be charged off in 31st March 2013 financial year will be 27,30,000 into 2 by 3, because 2 out of 3 years are completed. This much should be charged off, but how much is already charged off? 14,25,000 is already charged off. When? This is charged off in first year, right? So, just going back to that logic what we have always been discussing, year 0, year 1, year 2, year 3. Standing in first year, we thought, when we were standing here, we thought that it would be vested over 2 years, and that 28,50,000, we said here 14,25,000, and we thought maybe in next year we might charge off 14,25,000. But by the time you came to this period, you realize that vesting is not 2 years, vesting is over 3 years. So, when vesting is over 3 years, what you are now intelligently doing is, in this period, 2/3 of the cost should have been charged off, right? Out of that 2/3, 14,25,000 actually got charged off in first year. The differential will get charged off in the second year. That is the logic. So, that makes it 3,95,000. This should be charged off in the second year, which is 3,95,000. This is the amount to be charged off in second year, that is 31st March 2013. Right. Now, let us make the next working note. Let us call it working note 4. This is as on 31st March 14. Right. So, this is the vesting date. Right. Now, number of options. As on 31st March 13. So, that is the last year. How many options were there? 91,000. Then less unvested options lapsed. What is the number of unvested options lapsed? 3,500. So, that makes it number of options expected to be vested. Number of options expected to be vested, or basically actually vested. So, because this itself is the vesting date. So, that would be subtract 3,500, 87,500. That is the number of options actually vested, or these are those which are expected to be vested. Wherever you get a doubt, please use your calculator and make sure the calculation is right. Now move on to the next one. Cost per option. Cost per option is 30. Total cost. Total cost 3 into 4. 87,500 into 30, 26 lakhs 25,000. This is 1 minus 2. Right. So 26 lakhs 25,000. Then this should be charged off over 3 years, right? This should be charged off over 3 years as, why? As vesting condition is met. Now you will write one more explanation to justify that vesting condition is met. What is that vesting condition? Average earnings greater than or actual, let us say actual average earnings greater than or equal to 10%. What are the actual average earnings? 10.33% is greater than 10%, right? This 10.33% is coming from working note 1, that reference also I gave. So that examiner should not be surprised, oh, how did you get suddenly 10.33%? You got it from working note 1, that reference you are giving, right? So this is greater than 10%, so vesting condition is met. Excellent. Now cost for 31st March 2014 will be 26 lakhs 25,000 minus what? Minus year 1 cost minus year 2 cost, which will be 26 lakhs 25,000 minus what was our year 1 cost? 14 lakh 25,000. And what's our year 2 cost? Year 2 cost is 3 lakh 95,000. Come on, let us now check. 26 lakhs 25,000 minus 14 lakh 25 minus 3 lakh 95, how much that will come to? 8 lakh 5,000. Are we clear about this, friends? Friends, now let us come to the last working note, that is working note 4, right? This is about the actual exercise of those vested options. What is the information given? This is for exercise period. Okay. Now, what is the information given? Number of options vested. What is the number of options vested? All those 87,500 options got vested, correct or not? Then number of options exercised. What is the number of options exercised? The question says that 850 employees only exercised those options. Read that last point. 850 employees only exercise those options. So 850 employees into what is the number of options per employee? 100 stock options per employee. So that makes it 85,000. 85,000 options which got vested were actually exercised. Clear? Now vested options which lapsed. How many vested options would have been lapsed? Difference between the two, 1 minus 2. 2,500 of vested options actually got lapsed. Well, when you are going to pass a journal entry for exercise of options, what are you going to do? Debit what? Amount which comes in. How much will come in per option? 20 rupees per option. Then what is the cost? 30 rupees is the cost. Total is 50 rupees. 10 rupees is the face value. 40 rupees is the securities premium, and the cost portion attributable to these 2500 options you will transfer to general reserve. So this is the discussion what we are supposed to have in terms of working note. Now we are in a good position to start writing those journal entries. Friends, all the workings are completed now. Don't just write down the journal entries from what I write. I want you to take 5 minutes and try solving those journal entries on your own, and then let us cross check these answers. I hope you spent time and you actually wrote some journal entries in your notes. Now let us start discussing each of those entries. Come back. What is the first one? The first journal entry should have been passed on 31st March 2012. Now check what is the entry you passed. 14,25,000 is the cost, right? Employee compensation expense account debited to employee stock option outstanding account to the extent of 14,25,000, being employee compensation cost for 31st March 2012 for the financial year ended 31st March 2012 recognized as per working note 2. Simple. Give as per working note 2 because working note 2 is your detailed note what you have already given. So as per that you have given this. Excellent. In real life what do? In real life we can't say working note 2. As per the attached calculation, and basically with that journal entry there will be one calculation like what we have done in working note which will be pinned and filed in the records. Great. Now employee compensation cost should be charged off to P&L. For that the journal entry will be as on 31st March 12 P&L account debited to employee compensation cost 14,25,000. That's it. And being employee compensation cost transferred to P&L, that is the narration. So these are the entries what you should have passed as on 31st March 2012. Have you done that correctly? It's okay if you have not done that correctly. If there is any mistake, it's okay. Highlight that. Please don't just overwrite that. I repeat, wherever you make mistake, preferably with a separate color pen, please highlight that. The most common mistake what we would have been taught right from our school is how to hide mistakes. We shouldn't do that. If we ever make a mistake, highlight that and tell yourself, I am not going to repeat this. And you should actually make a lot of effort to make sure that you don't repeat that mistake. Right. Excellent. Now, friends, that's about 31st March 12. Move on to 31st March 13. What is the journal entry? Employee compensation cost account debited or employee compensation expense account debited 3,95,000 to employee stock option outstanding account to the extent of 3,95,000. Did you do that correctly? Excellent. Now, of course, the narration being cost for 31st March 2013 calculated and provided for as per working note 3, right. Then that employee compensation cost has to be transferred to P&L. P&L account debited to employee compensation expense to the extent of 3,95,000. So that completes your second year calculations and journal entries. Are we clear about that? Now move to third year. What is the third year calculation? 8,05,000 is the total cost. So write the entry. Employee compensation expense account debited 8,05,000 to employee stock option outstanding 8,05,000, and then P&L account debited to employee compensation expense 8,05,000. Of course, here again you should give in the narration reference to working note what we have written, right. So great. So friends, basically we completed 3 years calculations. Now we should talk about the exercise period. That exercise period calculation we have done in working note 5, right. So please correct it. I think we wrote it as working note 4, make it working note 5. That is the exercise period calculation. In exercise period, what is the journal entry that you are supposed to pass? 85,000 options became equity shares, right. Come on. Bank account debited 85,000 into 20. Then Employee stock option outstanding account debited 85,000 into 30. 2. Equity share capital 85,000 into 10. To securities premium 85,000 into 40. Are you clear about that? Being allotment of equity shares for the stock options. That is what it is. Working note 5. Now, the last point will be for transferring employee stock option outstanding on those 2,500 options, right? So, what is that last entry? Employee stock option outstanding account debited 2,500 into 30. 2,500 into 30, 75,000. To what? To general reserve. Being employee stock option outstanding on vested options which got lapsed, transferred to general reserve. That's all. These are all the entries what you should have written, and I hope based on all the calculations what we have done and all the examples what we solved, you are comfortable with this chapter, and please practice it because it's important. The more you practice, the more comfortable you get. It's a very important chapter. You get questions for a lot of marks. Alright friends, now let us look at a question from employee stock options. P Limited granted options for 8,000 equity shares of nominal value 10 on 1st October 20x0 at rupees 80 when market price was 170. Vesting period is 4.5 years. 4,000 unvested options lapsed on 1st December 2000x2. 3,000 options were exercised on 30th September 2000x5 and 1,000 vested options lapsed at the end of the exercise period. Past journal entries for the above transactions. Okay, alright. Before we start the journal entries, let us first understand some key points which we see from this question. P Limited granted options for 8,000 equity shares. Okay, right. So it started with 8,000 on 1st October 2000x0, and what is the period, vesting period? It says 4.5 years. Okay, I am just skipping for a minute the price point. It is for 4.5 years. We are on 1st October 2000x0. From 2000x0 October 1st, if you take 4.5 years, so first from that day till 31st of March 2000x1, there is half year, then x2, x3, x4, x5, right? So like this, there are 4.5 years. Now, second point, at 80, when the market price was 170, this option can be exercised at 80 when the market price was 170. So, what is the benefit? What is the benefit that somebody may get, best estimate of benefit that somebody may get because of these options? 170 minus 80, 90 rupees is the fair value of the option. What do you mean by fair value of the option? As you see in the question, it is the benefit that somebody may get because of this option. A share which is at 170 rupees, by having this paper called option, we can get it at 80 rupees. So, the fair value of the option is 90 rupees. 170 minus 80, 90 rupees. Okay, right. Now, you can say in one way, there is a concession at which those shares are being given to the employees. How much per share is the concession? The fair value of those options is 90. On how many such options do we have? We have that on 8,000 shares, right? Now, that is the total cost over what period? Over 4.5 years. So, at the end of every accounting period, you will have to check. I am repeating, at the end of every accounting period, you need to check what is the accounting we need to do. So, when is the first accounting period ending? 31st March 2000 x1. Okay. Then 31st March 2000 x2, x3, x4, x5. Like this, there are actually 5 accounting periods, but in the first period, there is only 6 months. That is the half year. Okay. And what happened? Vesting, then 4,000 unvested options lapsed on 1st December 2000 x2. So, before you came to 2000 x3, 31st March 2000 x3, some 4,000 unvested options lapsed. Okay, fine. So, if they lapsed, what do? You go to the 31st March and take a fresh look at it. Till this day, how much cost should have been considered? How much was already considered?
Based on that you will do the calculation. Alright friends, so this is the broad understanding. Other points also we can solve. So we will draw a timeline, we will plot this important information. After that we will start writing journal entries. Let's get started. Now look at this friends, it is starting on 1st October x0. First year is ending on 31st March x1, then 1 year, 31st March x2, 31st March x3, 31st March x4 and 31st March x5. Okay, right. So here on 1st October 2000 x0, how many shares were there? 8,000. Okay, basically options. Then on 31st March x1, how many were there? 8,000 only. Okay. 31st March x2, how many were there? 8,000. Okay, right. Concentrate carefully. It is on 1st December x2, somewhere here, that 4,000 got lapsed. So basically 8,000 minus 4,000, you have 4,000 options continuing as on 31st March 2000 x3. Is everybody clear about this? Right, as given in the question, 4,000 unvested options lapsed. Okay, unvested options. Okay, unvested options. This is just our rough work. Okay, right. Then what else do you see? 31st March 2000 x4, is there any change? No change. The same 4,000 is continuing. 31st March x5, how many were continuing? 4,000 only were continuing. Okay, right. Now listen carefully. After this you have 31st March x5, 1, 2, 3, 4, correct. So here on 30th September x5, okay, on 30th September x5 you have, out of this 4,000, okay, out of this 4,000, 3,000 were exercised and 1,000 lapsed. 1,000 lapsed. This happened on 30th September 2000 x5. So after the period was completed, so here they got vested, that is on 31st March 2000 x5 they got vested. After vesting, before 30th September 2000 x5, 3,000 of them got exercised and 1,000 lapsed even after vesting, or they were not exercised even after vesting. Okay, that is the story. Okay, right. Now what we will do is, first let us identify the journal entries at different dates on which you require journal entries. What are the different dates on which you require journal entries? It's a no-brainer. You require a journal entry here. Basically entries for that, then entries for this, entries for this, entries for this, entries of course for this and for this. Okay, so on the date of issue you don't have any journal entries, so here you don't have any journal entry, but at the end of every accounting period and on the date of vesting and exercise, basically you will have those journal entries. Okay, right. So let us do a small calculation and pass journal entry also. Okay, right. Come on, come to the solution. Okay, right. So this is journal entries with workings. Some students get worried, sir, where should I do workings? Where should I write journal entries? It's okay. You clearly write these are journal entries with workings. You give the working, you give the journal entry, let them be clear. Okay, examiner will appreciate that, don't worry. Okay, right, come on. Now, the first date is 31st March 2000 x1. Okay, what is the calculation that you are doing? Number of options, 8,000. Then basically I will say number of options live. Live means they are still active. I can call them active or live, both mean the same. Okay. Number of options live or active 8000. Then fair value is fair value of options is market price minus market price minus what? Market price minus issue price. Okay. Basically, fair value of options is the worth of options. You can also understand this as benefit in the future. Okay, benefit in the future is so much. Okay, right. So this is what? This is 170 minus 80 rupees 90. Okay, right. Then total period. This is over 4.5 years. This is a cost over 4.5 years. 8000 into 90 is the cost to the company. Okay, 8000 into 90 is the best estimate of cost to the company. I am repeating, 8000 into 90 is the best estimate of cost to the company, but that is a cost over 4.5 years. Now, period completed. Period completed is October to March, half year. Okay. Cost for this period, when I say cost for this period, this is 1st October X0 to 31st March X1. So this is the financial accounting year, financial year ending, right? 31st March 2000 X1. So in this period, what is the cost? Cost for this period is equal to 8000 into 90, that is the cost over 4.5 years, right? So 0.5 divided by 4.5 years, half year over 4.5 years. That is what I am doing. Come on, quickly do the calculation. So what will this look like? 8000 into 90 into 8000 into 90 into 0.5 divided by 4.5. This is 80,000. 80,000 is the cost for the period that we understood. Okay, this is basically the cost for the period. It is like payroll cost. Think about it. It is like payroll cost. We have these employees. For those employees in this period, this is the cost. Now, this expenditure for this period, which is like payroll cost, are we paying right now? No, we are accumulating it. Okay, we are accumulating it. We are not paying it right now. So it is like a payable. Okay, it is outstanding. In other words, it is outstanding. So let us write a journal entry to reflect this. There is an expense of 80,000 and that expense is payable or outstanding. So how do we write this in a journal entry? Employee compensation expense account debited 80,000 to employee stock options outstanding account 80,000 being expense for year ended 31st March X1 accounted as per the calculation. Okay, right. In real life, such calculation what we have done can form part of this, if you prepare a joint, if you prepare a JV, you can actually attach this with this calculation, right? Now, this employee compensation expense has to be charged off at the end of the accounting period. What do? P&L account debited. Same, 31st March 2000 X1, all these are 31st March X1, okay? P&L account debited 80,000 to this one, employee compensation expense 80,000 being expense charged off. Okay, of course, this will continue in the balance sheet. These are the entries for the first year. Alright, so this is done. Okay, now let us go to 31st March 2000 X2. 31st March 2000 X2, is there any change in this number? No. This was 6 months, this is 12 months, that's all. So there is no other change. Fair value hasn't changed, the number of options hasn't changed. Just instead of 6 months, this became 12 months. So there it is 80,000, here it will be 1,60,000, right? 12 months period. That's all, nothing else will change. Let us do a small working for it. 31st March X2 expense. Now I will not write the full story. You already know the calculation. What is the calculation? 8,000 into 90. We know how we got 90. Into what is the period? Listen carefully to this. What is the period that got over? 1.5 years is what got over. Out of 4.5 years. Okay, right. This is the cumulative expense which should be cumulatively, this much should have been charged off over 1.5 years. Is that statement correct or not? Yes. Minus whatever was already charged off till the end of previous period. What was already charged off in the previous period? 80,000 was already charged off in the previous period. I'll write this clearly, just understand. This is the cumulative expense for 1.5 years, okay, minus already charged off till the end of previous accounting period. I want everybody to concentrate on something. You may ask me, sir, why are you doing this kind of cumulative minus whatever is charged off? What are you gaining by doing this? I'll tell you what I'm gaining by doing this. Listen, this is an accounting estimate. As per accounting norms, every accounting estimate has to be revisited at the end of every accounting period. This is a principle that we follow, and because you have best approximation whenever you talk about an accounting estimate. This is an accounting estimate. You may ask me, sir, how are you calling this an accounting estimate? It is an accounting estimate because today there are 8,000 options, shares, which we will give. But actually, at the end of 4.5 years, will all these 8,000 stay? I don't know. I'm just assuming. Okay. Then the fair value we found to be 90. Maybe something goes wrong and fair value may fall, right? In this question it is not given, but for some reason fair value may fall, correct? It may fall, right? So in that case, at the end of 4.5 years, what would the fair value be? I don't know. So my best estimate is 90. That is what I know today. That is what I am assuming is continuing because there is no other information given. So, you talk about 1.5 years, 4.5 years. So all these actually are those estimates which are all these are elements which are going into that estimation. So what our accounting norms prefer is, forget what happened in the past. Okay, first to do this calculation. Till this period, 31st March 2000 X2, okay. till this period, forgetting what happened in the past, how much should have been cumulatively considered as cost? Calculate that. Okay, right. Once you arrive at that, then you will say, oh, minus, then you say, last time how much did you already debit? Acha, 80,000 already considered. The balance only now we will consider as cost for this accounting period. But in this process, what you will ensure is, if any estimations change, right? Maybe that 8,000 became 7,000 or 6,000, or that 90 rupees became 95 rupees or 80 rupees. Any such changes that happen will get incorporated into the calculation when you are doing it in this manner. I am repeating, my dear friends, please concentrate. Why is this important? If there is any change in the estimation means 8,000 options, whatever we have, say by the time you come to 2000 x2, for some reason in the question it says 1000 already gone. Oh, gone. Acha. Then I wouldn't have written 7,000, I wouldn't have written 8,000, I would have written that as 7,000. Or the question says the fair value at the end of 2000 x2 for the option is 70 rupees or 170 rupees, doesn't matter, right? So some value has changed, it is not 90 rupees, it is something more or less than 90 rupees. Then also I would have incorporated that into the calculation and arrived at the revised calculation of how much cumulatively should have been charged off till now minus whatever was already charged off in the last accounting period. That will give us the amount that should be charged in the current accounting period. Okay friends, this is the methodology, right? So please apply that. So here it is 2,40,000 minus 80,000, which is 1,60,000. No change in the assumptions, that is why it is very easy, right? But let us still stick to this fundamental principle, okay? That principle will help you even when some assumptions change, okay? You will see this from the next accounting year onwards, right? Okay, summarily, let me write the journal entries. What are the journal entries? As on 31st March 2000 x2, what are you writing? Employee compensation expense account debited 1,60,000 to employee stock options outstanding account 1,60,000. Okay, we already wrote the narration previously, whatever we have written being expense for year 2. Okay, right, being expense for year 2 as per our working. Okay, right. This is the expense recognition, and then we are talking about transferring this expense to P&L account. P&L account debited 1,60,000 to employee compensation expense account 1,60,000 being year 2 expense charged off. Okay, right. This is the year 2 accounting. Now let us move into year 3. Right. Now look at how you need to do this calculation. We are on 31st March 2000 x3. Okay, right. Concentrate carefully. Originally till last year there were 8,000 options. Out of 8,000 options, 4,000, I am dividing into two parts. Okay, 4,000 unvested options lapsed, implies cost recognized and accumulated as outstanding accumulated as outstanding is no longer a liability. Okay, is no longer a liability. If it is no longer a liability, there is a liability, you are saying it is no longer a liability, okay. That liability, a small point as per guidance note is, you will not transfer that cost to P&L account, because the moment you transfer it to P&L account, your profits for the current period will increase. Guidance note says these are special cases. So if for any reason like the unvested option got lapsed, okay, so if unvested option got lapsed, that liability, don't credit it to P&L to increase the current period's profit, credit it to general reserve. So you will not keep it as a liability for sure, but credit that to another revenue reserve called general reserve. Don't credit it to P&L. This is the requirement of guidance note. Why? The intention probably was that if you credit it to P&L, it will become easily available for distribution as dividend, and if something becomes easily available for distribution as dividend, if the company wants to say declare dividend and it isn't finding enough profits, they will find a way to make the unvested options lapse, and that amount, because these are not going to be small amounts by the way, they will be huge sums of money. So that company should not have an incentive or should not have that as a plan B to create profits and distribute dividends. So that could be one of the possibilities why they kind of came up with regulation like this. Whatever it is, what guidance note says is, you don't credit it to P&L, credit it to general reserve. Okay, write down, reduce liability, increase general reserve. Reduce liability means debit, increase general reserve means credit. Okay, right. For what amount? The amount cumulatively for 2 years till end of last year. What was the total amount? Till end of last year, the total amount was 2,40,000. Correct or not? 80,000 plus 1,60,000, total 2,40,000 was accumulated till the end of last accounting period. If I just split that, 1,20,000, 1,20,000. Okay, this 1,20,000 we are saying will be reduced from the liability and increased to general reserve, basically credited to general reserve. Is everybody clear about the logic? If you are clear about the logic, then we can easily pass a journal entry. See, this is our understanding, rough work. Okay, right. Now come to this 4,000. On these 4,000 options, till last year 1,20,000 was accumulated. Does that hold? Yeah, that holds. There is no problem with that. Okay. In the current year, again 4,000 into the principal, whatever we were talking about earlier, into 90 into 2.5 years out of 4.5 years. Okay, minus whatever was charged off till last year, that is 1,20,000. Okay, come on, let us calculate this. What does this come to? So this is 4,000 into 90 into 2.5 by 4.5, which is 2 lakhs minus 1,20,000, 80,000. Okay, right. Just to understand clearly, this 80,000 is an expense. This expense for 31st March 2000 X3 debited to P&L. Think about it. Okay, this expense for current period is debited to P&L, but the liability whatever we accumulated till last year, which is no longer required, you are not crediting to P&L. What are you doing, my dear friends? You are increasing or crediting to general reserve, but the expense for the period is debited to P&L. This is the treatment recommended by guidance note on ESOP. Now, a lot of times the guidance note interferes in cases like this only to bring consistency in the treatment. There will be some logic, and the logic which we spoke about is a fair logic. After that, much can be argued on both sides. You can say, hey, sir, no, I don't agree with this. Okay, what do you want to do? This amount of 1,20,000 should be credited to P&L. Yes, people fought like this. Then institute said some companies do like that, some companies do like this. Then how do we build consistency? To build consistency, let us say, let's be more conservative. Such gains are not normal. So such gain which are basically reversal of liabilities, let us not credit to P&L account, let us credit to general reserve. That seemed more prudent and more conservative to the institute. That is why this came into the guidance note. I hope everybody is clear about this. Okay, right. Based on this, now we can pass the journal entries. We will first pass journal entry for that 1,20,000 rupees which we are reducing from liability and transferring to general reserve. After that, we will pass journal entry for this expense also. Come on, let's get started. So based on all this discussion, what is the first journal entry we will pass, friends? That 1,20,000 let us transfer to general reserve. Please write down employee stock option outstanding account debited 1,20,000, okay, to general reserve 1,20,000 being accumulated cost outstanding on unvested and lapsed options 4,000 transferred as per guidance note. As per guidance note to general reserve. Okay, right. So this is basically half of accumulated cost outstanding. Okay, right. Then now we will talk about for the balance options which are still live. Okay, out of 8,000, 4,000 lapsed. 4,000 are still live. Okay, let us write journal entries for those. What are the journal entries for those? Expenses, right? Employee compensation, expense account debited 80,000, you know the calculation, to employee stock option outstanding account 80,000. Please write the narration. Right. Then year 3 expense as per the calculation. Right. Year 3 expense. Then this employee compensation expense will be charged off to P&L. P&L account debited 80,000 to employee compensation expense 80,000 being expense charged. Alright. So with that, year 3 accounting is completed. Now come back to this. Till here we completed. In year 4, is there any change? No change, right? So 4,000 only continue, one full year expenditure. So 80,000 is what it is going to be. We know, just now calculated 4,000 into, that calculation whatever you have done, similar calculation will do, we will get 80,000. 80,000 will be expense in this period. In this period also nothing is changing. So in this period also 80,000 will be the expenditure. Okay. So let us write for year 4 and year 5, basically the expenditure is 80,000 only. The 4,000 calculation is not changing. So journal entries will be similar. Just come and let's write those journal entries. Year 4, 31st March, X4, right? What will you write? 4,000 into 90 into 3.5 by 4.5, okay, minus what was accumulated till now, 1,20,000 plus 80, 2 lakhs was accumulated till now. Let us check what that calculation is coming to. 4000 into 90 into 3.5 by 4.5, which is 2,80,000 minus 2 lakhs, which is 80,000. We know this, we are just calculating this. Similarly, for year 5, what will that look like? 4,000 into 90 into 4.5 by 4.5 minus the 2 lakh plus 80,000. This 2,80,000 whatever was cumulatively calculated till last accounting period, you will consider. So, what will that be? 3,60,000 minus 2,80,000, which will be 80,000 rupees of expense in 31st March 2000 X5 also. So, basically 80,000, 80,000. Let us just write journal entries for these. So, X4, what are the journal entries? Basically same, X4, X5 entries have not changed, but please write separately in your notes. So, what is the entry? Employee compensation expense debited 80,000 to employee stock option outstanding 80,000. Please write narration, right? Then P&L account debited 80,000 to employee compensation expense 80,000, okay, being expense transfer to P&L. You are all professionals, you know already we passed quite a few journal entries, but for your notes please write them separately, okay, right. So, these are the two entries. Let's just take a little more time, but make sure you are writing both these entries. So, with that, entries till 31st March 2000 X5 will be completed. Then after you complete this, we will go to September 2000 X5, okay. There the exercise is happening. Now we will start talking about September 2000 X5. Now let us exactly understand what happened on this 31st March 2000 X5. There are 4,000 vested options, okay. After they got vested, 3,000 exercised, 1,000 lapsed. 1,000 lapsed, okay. For this 1,000 which got lapsed, the treatment is similar to what we have seen earlier. What is the treatment? Basically, whatever is the accumulated amount on account of these 1,000 options, right. So, just for understanding here, on all these 4,000 options, cumulatively 3,60,000 over 4.5 years got accumulated, yes or no? That is the calculation what we have done for 2000 X5, 31st March 2000 X5. Now, basically what you are saying is, out of this 2,70,000 and 90,000. In 3:1 ratio I am splitting, okay, 2,70,000 and 90,000. These got lapsed. So, this got lapsed means what will happen? Employee stock option outstanding debited 90,000 to general reserve 90,000. Over, this is done. We know the journal entry for this, we know why the entry is passed like this. This is as on 30th September 2000 X5, okay. We know the calculation now, right. Now, this is for vested, being vested options lapsed, okay, right, done. Now, let us come to these 3,000. What do you mean by they got exercised? Basically, people gave money to buy these 3,000 options which got vested. Now, they are going to be shares. How much money are they going to bring in? Exercise price is 80 rupees. That is given in the question. Something which had a market value of 170 when they get vested, the company said we will give it 80 rupees. So people brought in money. How much money was brought in? 3000 into 80 was brought in. Okay. For that, shares got allotted. So let us zoom into this piece now. So for 3000 shares, okay, rupees 80 per share brought in cash. Okay, right. Then issue price is rupees 170. What? Yes, issue price is 170. Now, in this issue price of 170, basically we are saying 80 rupees brought in cash as on 30th of September 2000 X5. Then rupees 90 per share is the accumulated expense outstanding. Okay, accumulated expense outstanding. Basically 3000 into 90 is what the 2,70,000 is. Okay, over 4.5 years. So gradually we just kept on accumulating that expense. Out of this issue price of 170, please understand, face value is rupees 10. Securities premium rupees 170 minus 10, 170 minus 10, 160. Okay. We are going to write a journal entry for this. Okay. Let us see how we will write that entry. Amount is coming in the form of cash. Bank account debited. How much? Bank account debited is rupees 80 into 3000, which is 2,40,000. Then that outstanding, that liability also we will now close. Okay. Employee stock option outstanding account debited 2,70,000. Okay, right. This is basically rupees 90 into 3000 over 4.5 years. Okay. 2. Equity share capital. What is the equity share capital? Rupees 10 into 3000, rupees 30,000. Then 2. Securities premium, rupees 160 into 3000, rupees 4,80,000, being 3000 options exercised. All right, that completes our journal entries. So I hope you already passed this entry for the vested options lapsed, and that entry is for the vested options which got exercised. That's all.
Now, friends, for 31st March 2000 X3, we did one treatment, but now all of us have this doubt. Sir, what is this? Why are we doing this detailed method? Earlier we solved problems by passing a net entry. Correct. Even now you can pass net entries. Okay. So this is in line with what we have already done in the past. So let us look at those net entries. This is also perfectly fine. Okay. Write down alternatively. So the reason why I solved in that way also is, when you look at study material or practice manuals, you should not be shocked. Hey, how are they solving like this? You can solve like that or like this also, no problem. Alternatively, okay, what can we do? We have 4,000 options remaining. Achha, okay. For these 4,000 options remaining, what is the cumulative expenditure that we accrued? Write down accrued cumulative expense. What is the accrued cumulative expense? 3,60,000 into 2.5 by 4.5 years. That comes to 2 lakhs. Correct or not? Right. Now, what did we previously charge off? Write down. Already charged is 80,000 plus 1,60,000. Okay. So basically accrued cumulative expense to date, okay, is 2 lakhs, but expenditure already charged off is 2,40,000. Okay. So there is a 40,000 rupees of excess. Okay. This is excess. Okay. What do you do with this excess? Transfer to general reserve. Transfer to general reserve. Okay. So this sounds very familiar, right? So you can pretty much solve like this also. So friends, come on, now tell me, what is the journal entry we will pass for this? Employee stock option outstanding account debited 40,000 to general reserve 40,000 being liability no longer required transferred. Okay. So friends, if you solve like this also, it is perfectly okay. So don't worry about it. Alternatively, you can pass the journal entries in a detailed manner. That is also okay.
Friends, before we start with the next question, let us have a broad understanding of what are the different types of conditions in an employee stock option plan. So, you have an employee stock option plan which has some conditions. So, there will be some terms and conditions given in the employee stock option plan. Now, this condition can be non-vesting condition or these can be vesting conditions. Now, what is the meaning of vesting and non-vesting? Vesting condition basically means those conditions when they are satisfied, the employee will be entitled to those stock options. For example, if we say employee has to work for 3 years, to be entitled to those employee stock option plan. So that is a vesting condition. Only when the employee satisfies the vesting condition, the employee will get those employee stock option plan, or the employee will be entitled to those shares under the employee stock option plan. Vesting conditions are basically those conditions which has to be satisfied for being entitled to the instruments under the employee stock option plan. Now, these vesting conditions are further divided into two types. One is called the service condition. Second one is called the performance condition. What is the service condition? I say you have to work for 3 years or 4 years. Some number, okay, that is the service condition. What is the performance condition? Performance condition is if certain performance parameters are met, then the employees would get those stock options, or the stock options would vest upon the employees. So, if you say there are performance condition could be if the profit increases by 10%, if the sales increases by 15% every year, or if the share price increases by 10%, 15%, or if the share price reaches some particular amount. Okay. So, performance condition basically measures the performance. The condition is related to performance. Whose performance? Performance may be of the company, maybe of the share price, maybe of the employee. It could be anybody's performance. Now, this performance condition is further divided into market based performance condition and non-market based performance condition. So, one is market based, for example, share price. So, the company may say, for example, Reliance, if the share price touches 3000, then we will give you stock options, or the stock options would vest. Now, share price reaching 3000 is not a condition which is controlled by the employees. It is based on the market. But of course, there is an indirect relation, because as the performance improves, the share price also improves, right? That is the market based condition, and there are other non-market based conditions. For example, profits. If the profit grows by 15%, 20%, those are called non-market based condition, right? A broader understanding of this condition is sufficient. Okay, more in depth of these you will learn at a CA final level, not at the CA intermediate level. Now, as far as vesting conditions are concerned, where we have service condition, okay, here you will not revise the fair value. We have done enough questions on this. You will not revise the fair value. You will take the fair value on the grant date, and only based on the service condition you will measure the stock, you will measure the employee expenses, right? Now, subsequently, if you realize that less number of employees would be entitled, then accordingly we will revise the expense, but fair value will not be revised. Fair value will not be revised. Number of stocks that will vest, that may be revised. Okay, that is as far as the service condition is concerned. Now, coming to performance condition, if it is a market based condition, you will revise fair value on balance sheet date. Okay, so whenever you calculate fair value on the balance sheet date, on that date you will revise. If it is a non-market based, again you will not revise fair value, meaning to say you will take the fair value of the grant date only. Okay. Now, at an intermediate level, most of the questions that are tested would be based on service and non-market related condition. This would, though it is given as a part of the guidance note, these are not generally tested at CA intermediate level. Okay. So, what you need to understand is, if it is a service condition, I will not revise the fair value. I will take the fair value on the grant date or of the grant date. If it is a non-market based condition, again I will not revise the fair value. I will take the fair value on the grant date. So, in these two situations, I will take fair value of grant date only. I will not revise the fair value subsequently. I will take the fair value of the grant date only. Now, having understood this, let us have a look at the question that we are about to discuss. At the beginning of year 1, an enterprise grants 10,000 stock options to a senior executive, conditional upon the executive remaining in employment of the enterprise until the end of 3 years. So, there is a 3 years service condition, and the exercise price is 40. So, what is the exercise price? 40. However, the exercise price drops to rupees 30 if the earnings of the enterprise increase by at least an average of 10% per year over the 3-year period. So, if the earnings increase by at least an average of 10%, the exercise price reduces. If the exercise price reduces, tell me one thing, is it beneficial for the employee or it is not beneficial for the employee? If the earnings increase, they are saying exercise price will come down to 30. If the earnings don't increase by an average of 10%, then the employee will have to pay 40 per share. But if the earnings improve, then the exercise price is reduced, meaning to say employee will have the benefit. So, now based on these conditions, what the employees will try to do, they will try to increase the profit so that their exercise price is reduced, right? Now, on the grant date, the enterprise estimates that, please remember, on the grant date, you are measuring on the grant date, the enterprise estimates that the fair value of the stock option with an exercise price of rupees 30 is 16. If the exercise price is rupees 40, the stock options have a fair value of is 12. Now, please remember, if the exercise price is reduced, the value of the options, the fair value of the options will be higher. Now, please remember, there are two exercise price 30, 40. At 30 we are saying the fair value of the option is 16, at 40 it is 12. Now you might be wondering, sir, why did the fair value reduce? Please remember 30 is more beneficial. If something is more beneficial, it will have a higher value. If something is less beneficial, it will have a lower value. If I further say it is 50, this may come down to 7. Sir, by how much amount will this price move? All of that you will understand at a CA final level. For now, just understand, if I can buy something at 30, the same share, the share doesn't change. If I can buy at 30, say there is a paper which says you can buy at 30. Here is another paper which says you can buy at 40. Which is more valuable? This is more valuable because by using this I can buy at 30. So the fair value of the option is accordingly higher, right? So now coming back to the question, we have two fair values. Now we have more information. During year 1, the earnings of the enterprise increased by 12% and the enterprise expects that earnings will continue to increase at this rate over the next 2 years. The enterprise therefore expects that the earning target will be achieved and hence the stock option will have an exercise price of 30. Now please remember, the condition here is a performance condition. What is the performance condition? Profit has to improve. Now the performance condition is not market related. The performance condition is profit related. Because it is profit related, it is not market related. Now because it is not market related, we will subsequently not revise the fair value at the respective balance sheet date. But please remember, we will take the fair value of grant date, and this 16 and 12 both are the fair value of the grant date only. So if the exercise price is 30, we will take fair value at 16. If the exercise price is 40, we will take the fair value at 12. Please remember, we are not changing the fair value subsequently. We are calculating the fair value on the grant date, and depending on the information that is being available, whether it will be 40 or whether it will be 30, based on that we will take the valuation. So at the end of year 1, we are saying 10,000 share options, fair value of 16 because the exercise price is 30, and this is for 3 years period, so we will take 1 by 3. So 10,000 into 16 divided by 3, first year expense will be 53,333. This is year 1 expense. Okay. Now year 2, during year 2 the earnings of the enterprise increased by 13%. First year 12%, now 13%, means it will be more than 10%. The enterprise continues to expect that the earnings target will be achieved. So in year 2, now in year 2 estimated exercise price is again 30. So we will have 10,000 here into 16 is the fair value into 2 by 3, that is 53,333 into 2. If I do, I get 106666, 106666. This is the cumulative expense. Cumulatively, we have to make a expense of 1,06,666. So expense for year 2 will be 106666 minus 533333, which is 53333. Okay. Then in year 3, during year 3 the earnings of the enterprise increased by only 3% and therefore the earning targets was not achieved. So in year 3 it is only by 3%, so averagely it is not gone up by 10%, so it is not achieved. The executive completes 3 years of service. So the executive has completed 3 years of service. Now if the 10% target is not met, what is the exercise price? The exercise price is 40. So what is the fair value now? Fair value is 12. Please remember, fair value is not on the balance sheet date, fair value is on the grant date, and as per the grant date the fair value is 12. So in year 3, 10,000 into 12 into 3 by 3, which is 1,20,000 cumulative. So expense for year 3, that will be 1,20,000 minus 1,666, that will be 13,334. Okay, that will be the expense for year 3. Let's now have a look at another question. On 1st of April of year 1, a company offered 100 shares to each of its 500 employees at rupees 50 per share. The employees are given an year to accept the offer. So, on 1st of April they have offered and they have 1 year to accept the offer. The shares issued under the plan shall be subject to a lock-in period on transfer for 3 years from the grant date. So, the shares will be locked in. Locked in meaning you cannot sell the shares for a period of 3 years. The market price of the shares on the grant date is rupees 60. Due to post-vesting restriction, the fair value of the shares issued under the plan is 56 and the fair value per option worked out to be rupees 6. Now here let's understand few things. We are on 1st of April of year 1 and the employees have 1 year, that is till 31st March of year 2, they can exercise their option. Now on this date the market price is 60, but there are some restrictions on the shares. Whatever shares the employees will buy, those shares have restriction. Now tell me one thing, if there is a land and it does not have any restriction, it will have some value. But if on the same land I put some restriction, like you cannot give it out on for commercial purpose, or you cannot build a building, or you cannot have a building more than 2 floors or 3 floors. If some restriction are put on that, then the value of that particular asset goes down. So here also, though the market price is 60, because of the restriction, the fair value of the shares is 56. This is not the fair value of the option. For that, we need to check the exercise price. Exercise price is 50. So something of fair value 56, I can buy at 50. The value or the fair value is considered to be 6. This is more like an intrinsic value, because for fair value, we also need to bring in the time value of money and the changes in share price and all of that. For example, just to give you a perspective, I can pay 50 on 31st of March of year 2. On this date, I can pay 50 and get those shares. Now, the value of 50 today, the value may be only 47 due to time value of money. Correct or not? So, today if I have 47, I can put that into a deposit, I can get 50 and using that 50, I can buy those shares. So, there is a time value factor also, but we will not consider time value factor at intermediate level because it is slightly an advanced concept which you will understand at a CA final level, right. So, 56 minus 56 is the value. This is the fair value of the option. This is the fair value of the option and this is the fair value of the option which will be used to calculate the employee expenses. Now, if I come back to the question, it says on 1st of April, the company offered 100 shares to 500 employees. So, on this date, it has been given to 500 employees, okay, and each employee has been given 100, okay. Then, on 31st of March of year 2, 400 employees accepted the offer and paid rupees 50 per share. So here, my actual vesting is 400. So, my expense will also be based on 400. There is no need to calculate anything which is expected. So, expense will be 400 into 100 into 6, which is 2,40,000. Entire 2,40,000 will be accounted for as an expense in the first year itself because there is only 1 year. Then record the issue of share in the books of the company. So, the question is asked us to issue the record of share. Now, please remember, for issuing share, the consideration, you can consider it to be cash, which is 400 into 100 into 50 plus employee compensation expense, which we have calculated to be 2,40,000. So, 400 into 100 is 40,000 into 50 is 20 lakhs. So, this 20 lakhs plus employee compensation expense of 2,40,000 that we will consider to account for share issue. So, here what we will do is, first expense will be employee compensation expense 2,40,000 to employee stock option outstanding account 2,40,000. Then when you receive cash for shares, you will say cash or bank debit. How much? 400 into 100. 400 into 100 into 50, you will get 20 lakhs. Then this ESOP is employee stock option outstanding account. Employee stock option outstanding account, you will debit by 2,40,000. 40,000, right? 2, equity share capital, how many shares? 400 into 100 into 10, so 4 lakhs. And to securities premium, the balance amount, so 22 lakhs 40,000, 22 lakhs 40,000 minus 4 lakhs will give us 18 lakhs 40,000. So, this is the accounting entry. The first entry I have just passed for your understanding. Only the second entry is being asked in the question. Now, here the only thing you have to keep in mind is, don't get confused between this fair value 56 and this fair value that we have calculated of 6. Okay. If no information is given, you can consider fair value of share minus exercise price to be the intrinsic value, which can also be considered as the fair value of the option. Okay. This is a thing you can use for calculating if information is not available. Now, here instead of passing to these two separate entries, you can combine both of these and pass a single entry also. This employee compensation expense, instead of having it here, you can bring it and you can merge it here, and also you need to transfer the employee stock expense account to P&L. So, this is another entry, employee compensation expense, which is 2,40,000 and 2,40,000. Okay. So, this is another entry which you would need to pass.